We've just seen the best return for a 60-40 mix going back to December 1991. We're talking about a close to 10% gain because yields were aggressively lower across the curve. 2-year down 40 basis points, 10-year down 60. Just monster moves, Lisa, in fixed income.
And the last time that we saw this kind of move was December 1991, when the USSR was dissolved, and there was a lot of questions internationally.
That's great framing.
About what was going to happen. It wasn't that people just were suddenly coming to the realization that everything was fantastic and we would achieve the soft landing that the Fed sought out to achieve.
Are we pricing perfection? Right? Just the ultimate soft landing, which means fixed income can rally, growth is slower, rates get cut, but equities do okay because we don't go into recession.
How do we even understand what's being priced in? And I know that I've just been asking a lot of questions this morning, but one thing that I've been wondering about is when you talk about big tech, what do you understand in evaluation when people say that artificial intelligence is a moonshot and it's going to yield these incredible productivity gains and you're going to see profits surge because they're going to be the only game in town? How do you then understand evaluation, right? How do you then understand whether people have gotten over their skis when it is a technological advancement that people are betting on and the monetization of that? And then you bleed it into the rest of the market, which is still lackluster. And you're seeing money go out of small cap companies. So I don't really think that there is an easy way to dissect what price to perfection means at this moment.
We've done equities, we've done bonds. Let's push the bond move through the FX market. I think you know what's been going on over the last month. Dollar, weaker, euro, stronger. Just short of 109 this morning. We've pulled back more recently, but still, that was the best month for the euro of the year so far. Now, we've had the call of the morning so far from Jeff Yu of BNY Mellon. Jeff Yu saying parity on the horizon, ECB cuts first. ECB cuts first.
And George Saravellos over at Deutsche Bank agrees with him, also saying the ECB will cut first. Euro parity is a pretty bold call, considering that a lot of people are saying that we're seeing the beginning of a protracted dollar decline. Does euro parity with the dollar mean that there is global weakness that continues to put the rest of the world on the back foot and the U.S. very much still in the center?
Got to make a China call as well. Making a China call has been so tough over the last 12 months. We'll get to that in just a moment. Under surveillance this morning, Israel resuming fighting against Hamas after a week-long truce between the sides ended. Israel saying its jets were already striking Hamas targets in Gaza. Shortly after the ceasefire expired, the truce brought the release of captives on both sides, as well as allowing for more aid to flow into Gaza. It's thought Hamas is still holding around 130 hostages after taking 240 when the war broke out. Lisa, we were talking about how fragile that truce was. That truce ends.
It's not a complete surprise. It's deeply unfortunate in many ways, but it's not a surprise given that it was getting increasingly tense with every hostage negotiation. There are a lot of questions about how this evolves going forward. Qatar has said that it's still talking actively about negotiating some additional truce, but we've been saying this again and again, and we have to keep repeating it. The goals have not changed. Israel still says that it needs to eradicate Hamas in order to have a country. And Hamas, the Hamas leader, came out over the past couple of days and said that this was just a beginner, a teaser to what was to come, and that there would be many worse things than October 7th. So these are some of the talks on both sides that highlight how neither side has given up their underlying objective.
There's some shocking rhetoric there,
Shocking.
isn't it? So in about 45 minutes' time, we'll get the Anne-Marie view on things. AMA's joining us from Washington. Also need to talk about this. 2 years behind schedule. Congratulations to the team at Tesla launching its new Cybertruck, but saying its cheapest model won't be available until 2025. Production delays have held back the car, with CEO Elon Musk calling it, quote, insanely difficult to produce. The most expensive version of the truck, the Cyber Beast, priced at almost $100,000. Lisa, that will begin delivery next year.
Do you think it's attractive?
So I said initially when this first came out, it looked like a child had drawn it, right? I thought that this is, build a truck, draw a truck that you think, totally.
Yeah.
How wrong was I? Because the order book just went through the roof.
So one of the reasons why it's insanely difficult to make is because it's stainless steel on the outside, which evidently is very difficult to create into components that are easily placed together. I'm not an auto manufacturing expert, as you probably could just tell, but to me, this really raises this question, will this be the new look? I mean, is this basically going to be, Back to the Future, the models? What was it called? The DeLorean with the with the doors that went open?
You know your cars. Come on, give me a break.
Yeah, I know the DeLorean. I know a fictional car that came out of the 1980s movie. But there is a real question here about exactly the tone that it sets, whether it competes with the F-150, whether this is for commercial use or whether people just want big vehicles that look like their kids drew them.
Do they want EVs or do they just want Teslas? Can we talk about that a little bit more? Do people just want Teslas in this country, or do they actually want EVs? When you speak to Ford, to GM, you talk about their numbers. I don't hear the same thing from Elon Musk.
What John Lawler said yesterday I thought was really interesting, which is basically initially there was the ability to price things more highly, and you could have more of a luxury price point because the people who sought out electric vehicles were looking to be the early adopters, right? Now it's a different kind of equation. I'll say, as somebody who is shopping for a car, you're looking for cost, you're looking for ease of refueling, of being able to keep going. And sure, you're also thinking about the environmental factors, but you put all those things together and you get a very different car that people gravitate toward than some of the Teslas at the price points and the margins that they've been selling them at.
It is funny that this is the week we're talking about the lack of advertising on X. And at the same time, here's a company that is getting free marketing the world over this week, and the focus is on this brand. There's a great video out on Twitter of this truck towing a Porsche, beating a Porsche in a drag race.
Yeah.
What does Porsche do in response to that?
I don't know. I really don't. It's a good question. And this is something that all of the legacy car makers are having to deal with, including the luxury ones. And luxury hasn't been immune to this. And we've been hearing that from BMW and the like. So, you know, this is, okay, over to you, Porsche.
Free advertising, Tesla just, you know, marketing genius. Absolutely. Let's finish on this. Shares of LVMH falling this morning after Morgan Stanley downgraded the luxury retailer to equal weight from overweight, expecting the company to face a, quote, difficult start to next year, given its dependence on spending out of China. All of this as China's biggest celebrities flock to Louis Vuitton's first ever fashion show in Hong Kong as they look to boost business in the region. The call on China has been tremendously difficult over the last 12 months. Let's have that conversation right now with Sarah Hewen, Head of Europe and America's Research at Standard Chartered. Sarah, before we get into thresholds for rate cuts, can we just build on that just a touch? Europe and the dependence on China, what kind of moves can we expect in the Chinese economy in the next 12 months? And what do the last 12 months mean for the European economy going forward?
In terms of China, clearly the situation has been very challenging, but actually growth has performed better than expected. We've always had an above consensus outlook on the Chinese economy, and we've seen consensus moving up towards us, and indeed IMF forecasts also moving up towards our own forecasts. Clearly, the real estate market is going to be struggling for some time, but what we're seeing is consumer spending recovering gradually. Consumers are drawing on savings, even though income growth is relatively weak and consumer confidence is not great. But we are seeing a pickup in consumer spending. And of course, China has some huge strengths in particular industries, and we're seeing real strong growth in EV and other technology-related production and exports. So growth likely slower next year than this year, but not dramatically so. We would expect that the official growth target will probably be continued at 5% for next year. In terms of Europe, real challenges for the domestic economy. We've seen already negative growth across much of the individual countries in the region, and it seems as if policy tightening is really taking effect. Interestingly, though, unemployment stays relatively low so far, and that probably is going to be the final leg to fall for the European economies.
Sarah, what do you think of the call that we heard from Jeff Yu at BNY Mellon earlier this morning, that next year we could see parity for the euro versus the dollar?
Well, we would agree that the ECB looks likely to ease rates before the Fed, and the data on the economy certainly would suggest that the US economy is in much better shape than the European economies. Inflation is coming down very rapidly in the euro area. It's coming down in the US. We have some questions about how getting from 3% to 2%, that final leg for US inflation, how well that can be achieved, or how quickly that can be achieved while you still have a pretty solid labour market. So we would expect ECB easing ahead of the Fed to to point to a weaker euro. Once we get clear signs that the US unemployment rate is rising, that's the point at which we think the dollar starts to come under more pressure. But certainly our forecast for euro over the coming weeks and months would be weaker than it is currently.
So is next year just deja vu all over again? Are we basically getting the U.S. being, the cleanest shirt in the laundry bin or whatever cliche people are going to put out there, and we're going to get them basically getting Goldilocks, soft landing, and the rest of the world's in a world of hurt?
I mean, we're thinking that the US is going to, the economy is going to stall later next year. The impact of policy tightening is clearly coming through, and that impact is going to intensify over the next few quarters. So although employment, the jobs market is relatively solid at the moment, then it's likely that we'll start to see hiring fading, unemployment rising. Consumers, of course, that have been such an important part of this recovery over the last couple of years, consumers are starting to run short on savings, certainly for the lower income quartiles, and the impact of higher unemployment, I think, will undermine sentiment such that the consumer starts to fade away. So certainly for the US economy next year, we think that growth is going to stall in the second half. It's not a particularly great outlook really for any of the major economies, and that's sort of what you would expect given the extent of policy tightening that we've seen over the past year, 18 months or so.
And the fact that we just had 5% plus GDP growth in the third quarter in the United States. Sarah, thank you for the update. Sarah Hewen there of Standard Chartered. I really appreciate what Standard Chartered have done over the last couple of weeks. A lot of people out there put Canada-based guidance out there for the Federal Reserve. The cuts are going to come, and then you choose a date on the calendar. They put out some threshold-based guidance and basically indicated that they think this is where the Fed's going to cut. If unemployment gets to 4.5, core PCE comes down to 3, that should allow the Federal Reserve to pull back. That's far more useful to me than taking a guess on a calendar and saying June, back end, second half, first half, early March, whatever.
But this is part of the reason why Chris Waller actually made such an impact on the market, because he did sort of set loose parameters. Maybe they were more extreme, but talking about how if inflation's come back down to target, it makes no sense at all to keep rates where they are. So at this point, people take a look at what's in the pipeline in terms of disinflation, at least over the next couple of weeks and the next couple of months, and they say we're going to meet those thresholds.
That if is not a big if.
Yes.
If you're listening to Neil Dutt of Renaissance Macro.
Exactly. Well, that's what I was talking about.
Fantastic exchange on this program in the last 24 hours. You can find that on Bloomberg.com. From New York City this morning, good morning. Your equity market just about unchanged on the S&P. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. We will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
lesson of 2022 and early 2023 was that we cannot control what happens in the rest of the world, especially as it pertains to the supply of oil, the supply of natural gas. So from my perspective, if we get another shock in that market, and by the way, it doesn't have to be because of a war, although in the past 2 years that has been the case. It could be simply that OPEC Plus decides to curtail supply, and we get a Brent going back up to the low 90s as a result of that. Again, it's a question of how much they curtail supply by, but that's the biggest risk right now.
That was Wednesday, and then yesterday, that's exactly what OPEC Plus did. Crude this morning, 76 on WTI, Brent crude, $81.11. We'll get into OPEC Plus in just a moment. If you are just joining us, big day today. Chairman Powell closing out Fed speak, going into the quiet period ahead of the December Federal Reserve meeting with the last word on a big week for a lot of Fed speakers. We've talked about the selective hearing in bond markets. We seem to be listening to the likes of Waller, Bostic, ignoring the rest. So let's listen to the likes of Bostic and Waller. Bostic says this: our research and input from business leaders tell me the downward trajectory of inflation will likely continue. Governor Waller said this: something appears to be giving, and it's the pace of the economy. That line to me, Mike McKee and I went back and forth on that just a little bit yesterday. What's giving in the US economy right now?
There is a sense that people are looking for discounts. There is a sense that consumers are starting to push back a little bit on the margins to high prices. There is a sense that certain consumers in particular are having a difficult time. And I think about Walmart's CEO talking about outright deflation in goods. And I'm thinking about saying that over the last 90 days, they'd seen a market deterioration in demand. So maybe that's some of it. I think the other thing is, if you take a look at small businesses, they're not doing well. And if you take a look at their stocks, but if you also take a look at their capital objectives and how they're going to achieve them, this is a tough moment for those, and they employ a lot of people in this country.
Anecdotal data that they get, you see it in the beige book, they hear about it all the time. It's been telling them this for a while. In fact, I would go back to August. We heard this in Jackson Hole. I think it was Patrick Harker who said exactly the same thing about things getting a little bit more difficult. Stop hiking.
Well, and he said that anecdotes have been a better guide than some of the more traditional data. Mary Daly also spoke yesterday, and she's been really thoughtful about this, and she really focuses on some of the anecdotal data, which she puts together and doesn't call anecdotes, but she calls it sort of qualitative data.
It sounds fancier.
Yes, exactly. It sounds like it's a sort of more scientific approach, which that's how she views it. There is a question here. When she looks out, she says she's not even thinking about rate cuts. And she said that. She pushed back more aggressively than some of the others. So it raises this question: are people seeing different anecdotes depending on the region?
True.
Is this reliable? I mean, I'm telling you, this is such a confusing moment. And Fed officials are just as confused as
Yeah, but what did Daly tell you back at the Economic Club in New York? When things start to conflict, when you start to get more and more contradictory evidence, it means you're at a turning point.
Always. And then we just don't know what the turning point is, too. And this is sort of normal, but it's been a while. And so if the question is, we don't really know where we're heading, how can Fed officials give true guidance?
Do you think this is what OPEC Plus is trying to get ahead of, going into next year and beyond?
You know, I spent a lot of time thinking about OPEC Plus because I found that also confusing. As you can see, I feel very confused after
about a lot of issues.
About a lot of issues. But they basically came out and said voluntary cuts, maybe trying to placate Angola and Nigeria. To me, how much is OPEC Plus basically a leveraged vehicle of China? How much do they basically give a sense of Chinese demand more than they do America? And how much are they leaning into this idea that economy is slowing much more significantly?
Markets in Asia becoming increasingly important over the years for that group of oil exporters. Nadia Martin-Wiggin joins us now, the director at Svelland Capital. Nadia, let's start there. This word voluntary, how important is that word voluntary at OPEC Plus?
I think the market finds the word voluntary very problematic because it means that the group did not manage to together agree that this is what we actually have to do. And this is why the oil price has not strengthened since it was announced.
What kind of follow-through do you expect off the back of the announcement then? We know what the market's preoccupied with, a single word. What are you telling clients?
Well, that on the margin, we then see that there's around 300,000 barrels per day coming less from UAE, coming less from Kuwait, and 100,000 barrels per day coming less from Saudi Arabia. So that makes Q1 look slightly better and call it a balanced market, right? But it's only a Q1 cut, and it doesn't really change the picture. And again, you know, what it was different about this OPEC Plus meeting is that it's not a long duration cut, right? Last year, they made it a long duration. And now they're only looking at 3 months forward. The expectation for them is, of course, that we will start to see demand pick up, and then we will see draws, especially into the second half of next year. But what we saw throughout this quarter is a lack of draws does not make the oil price rally, right? And we're going to see the same in the first quarter, we believe.
There was a story, Nadia, on the Bloomberg talking about how algorithmic traders are confusing all of this and that we can't really get the same kind of signal from oil prices because of this. Do you buy that, or do you think that oil prices are sending a very strong signal about growth globally, but also particularly in China?
Well, I think oil prices are okay. You know, it's not a low oil price. It's not a high oil price. It's a healthy oil price. I think what we have to get our heads around is the fact that China has changed as an economy, right? And so we're not going to see the levels of GDP growth that we were used to, but probably where we are this year, things will continue to go on year over year. Of course, this year we saw 1.5 million barrels per day year-on-year growth in oil demand, and in our view, we'll see 600,000 barrels per day next year, which is probably slightly higher than consensus. But it's not only China, it's also India, it's also non-OECD Asia, ex-China and India, that are really driving things. In contrast to the US, that even though the US economy, we're firm believers in a soft landing, the problem is the rise in fuel efficiency every year in the US. And this is why the driving season disappointed this year, and it's probably going to disappoint next year. Add into that Tesla and EV purchases, that is also a headwind on that demand growth.
If that's really a big driver of why prices, as you call them, healthy, but not as elevated as people would expect, how much can we see prices continue to decline as EV adoption and some of the other types of non-fossil fuel economies build up?
I think the main difference there, I mean, on the demand side, yes, we will see slow demand, and, you know, already for next year, demand growth in our view is 1.4 million barrels per day year on year for the whole world global demand growth, right? But some estimates are already calling for less than 1 million barrels per day, right? I think the other aspect, though, is the supply side, right? Is that right now we are in this still shale boom, and that will continue for probably another, max 2 million barrels per day. And, we'll say peak US production will be at 15.5 million barrels per day. So when we think about the balance in prices, we will then still have strong oil prices because these long cycle investments are not happening at the pace that they have in the past, given this relatively healthy oil price. So I don't see a long-term negative a price path for oil, and I expect actually it to strengthen over the coming years. We just have to get through this U.S. shale boom growth period.
Nadia, appreciate your view. Nadia Martin-Wiggin there of Svelland Capital. Imagine if a central bank came out, news conference, we're hiking rates, but it's voluntary. How would the market respond to that? Exactly how crude responded to it.
That's what I was going to say, just completely confused, and that's basically the response in crude.
Pfizer, I want to talk about that name in the pre-market right now. Bit of news for you. Stock is dropping, and it's dropping development of its experimental weight loss pill after more than half of patients in a mid-stage study, Lisa, had to stop taking it due to side effects like nausea and vomiting. We're down 4% here in the pre-market.
We've all been kind of waiting for this, right? I mean, to some degree, because we hear anecdotally about some of the side effects of Ozempic and some of the others, and there's this question, at what point is it problematic? And it seems like Pfizer has reached that threshold. So this raises a couple of questions. Number one, is there going to be similar types of follow-on to some of the more established drugs as people take them for longer? And then number two, how high is the barrier to entry as everybody in the entire industry tries to get in on trying to, get weight loss to happen?
Look, they had a massive boom off the back of a pandemic. It's faded. It's gone. Now they need to get back to work and catch up with Novo Nordisk and Eli Lilly.
Are you saying that basically Ozempic is the new COVID vaccine?
No, I'm saying that the COVID vaccine was mandated in such a way that it benefited that company in a disproportionate manner than it did other pharmaceutical companies in that era.
Absolutely, that's true.
And I'm looking at these moves this morning, and as this stock drops, if you just pull up the charts of Lilly, Novo Nordisk, just see the chart briefly, just starting to inflect the other way. Just off the lows of the session on both of those names elsewhere.
Yeah, and they've got more established footprints, and maybe they also have less high to fall from, to your point, because Pfizer really did benefit so significantly. I just wonder, are people really going to take this for the rest of their lives? And how much of an
I
advancement
don't know.
you're
I mean,
gonna
I just find it fascinating.
It is fascinating.
You talk about this morning, you've got
Yeah.
more questions than answers. This subject right here, I have so many questions about.
I agree with that.
It's absolutely fascinating what it could change and all the rest. What could Chairman Powell change about this market rally through the month of November? Chairman Powell coming up a little bit later. We hear from him not once, but twice.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities
could face bigger challenges next.
Was going to keep rain World Cup. This is a three.
As the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
The top names in global leadership are on Bloomberg.
What we've just delivered are significant tax cuts. For business, we will be the only major G7 economy, certainly, and even broader than that, where you get a total write-off against your taxes for capital investment. And it comes on top of the fact that our corporation tax rate here is lower than any other G7 economy. That's an incredibly generous regime to attract business investment.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
We could be in this pre-recession period. Things could get much worse from here.
Our view is the economy is slowing, but it's relatively stable, and we're going to see growth into the first half of next year.
It's clear that there's more disinflation despite that growth.
What I'm really focused on right now continues to be the inflation data.
For now, inflation is still too high, even if moving in the right direction.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
There's a real sense of exhaustion in this market after the month of November. Let's get you to the weekend. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Your equity market this December. Good morning, December. Equities totally unchanged on the S&P 500. Through November, equities rip bonds rip, yields plunge. Chairman Powell, is he going to disrupt the party a little bit later?
Well, a lot of people are saying probably not, but that's the big question. I will just say that as I was telling everybody all of the questions that I have about absolutely everything, and I keep telling you about how I don't understand anything, someone sent in Led Zeppelin's Dazed and Confused to me so that I could really kind of, just vibe with that this morning. That's sort of where we all feel, I think. There's a bit of whipsaw after so much ping pong.
Bond market has supported this massive move in equities. If you're looking at the 60-40 portfolio, you shared that stat earlier. I think it's worth repeating. To see 60-40 deliver the best month since when? 1991.
December 1991 when the USSR was, when it was dissolved.
What happened to the end of the 60-40 portfolio?
Well, is this the beginning of the reprisal of it? And this is really the ultimate question. Can bonds and stocks continue to rally together for a longer period of time? I don't know the answer because we don't actually understand where inflation is going to settle out at. Some people are saying it could for a bit longer. Some people saying that it's gone too far too fast, but it doesn't mean that the moves are actually wrong. Other people are saying that either we're going to get reinflation to some degree come next year, and then you get suddenly this real concern and a whipsaw action where bonds lose value, or the opposite, we go back to 2% in a heartbeat, and everything is Goldilocks, and people lean into the moves that we've already seen.
That's the bet, right? The soft landing, a perfect soft landing, which is the bet that JP Morgan and Marko Klanovic and the team are pushing back against. They think it's too perfect, too pretty, too good, and ultimately it will disappoint. And if you're trying to wonder what will break that correlation between stocks and bonds, without a doubt, it would have to be bad data. Bad data is going to keep pushing this bond market in the direction it's been moving in, and maybe push the equity market in a different direction.
It strikes me that this cycle is so different from the last few, where there was some sort of crisis, and then there was a massive increase in unemployment, a massive increase in defaults, there was a massive disruption in the economic trajectory. We're not looking at that kind of recession, it sounds like, from everybody's accounts, because the U.S. economy is in pretty good shape, because the labor market is so strong. If that's the case, how do you price in something that isn't so catastrophic? And it goes to Mohamed El-Erian's point about, the era of crises and perma-crisis, and how you sort of get out of that mentality into something that maybe looks different.
Great piece this morning from Mohamed on Bloomberg Opinion, the risks of extrapolating out understandable euphoria.
Yeah.
There's a lot of risk around that story, a lot of risk around this story. I want to pick out a single name for you before we get moving. Pfizer was down about 4% in the pre-market. It's now down about 3 and change. This is a story for them this morning. Dropping development of its experimental weight loss pill after more than half of patients in a mid-stage study had to stop taking it due to side effects. Lisa, not very pretty side effects either.
No, we don't have to get into it. It's pretty early in the U.S. hours. There's a question here, though, with Pfizer and the big move. First of all, yes, how much of a bit lift did they get from the pandemic, given that they were the forerunner with the vaccine? But aside from that, the fact that an experimental drug being pulled from the experiment causing this type of move in a massive stock shows the hopes and the dreams around some of these weight loss drugs and what they can do for profit.
It's why Lilly is up. It's why Novo Nordisk is absolutely ripped year to date. More on that in just a moment. Here are the scores this Friday morning, December 1st. Equities going absolutely nowhere on the S&P 500. I get so excited about Christmas, Bramo. Month of December.
How's
so
the tree?
Important to me. Tree looks fantastic.
Mariah Carey?
Mariah Carey's going on a little bit later.
Oh, yeah, you haven't done it?
I have not played Mariah just yet. That will happen today. I waited because you all had a go at me for putting the tree up.
You felt shamed?
Too early. I felt absolutely shamed, yeah. I felt really sad. I'd sit there at night crying, upset, looking at my Christmas tree lights.
If you want to listen to Mariah Carey,
thank you.
I think that
Appreciate it.
You should enjoy it.
TK's putting up the tree today.
Is it? No, he's
Yeah.
not. He puts it up December 21st.
TK goes to the local school, drops a significant amount of money on a Christmas tree, just a virtue signal to everyone about, whatever, then puts it in the corner of the living room and doesn't do anything with it for 3 weeks. Just sits there.
It's the scent. It's the spirit.
I don't think there's much spirit going on there whatsoever.
I hear you.
That's stocks, here's bonds. Big move last week, big move last month. Yields down 40 basis points at the front end, down 60 on a 10-year, over the month on a 10-year at the moment, Lisa. 434.17, yields up just a single basis point.
I know you're going to be excited about this. 10 a.m. we get ISM manufacturing as well as U.S. construction spending, but we've been talking about the manufacturing recession that's been well underway for more than a year. That sub-50 read on the ISM manufacturing index. Does that continue to deepen? Is this the pain that people are feeling that belies the strength that keeps going in the services spend? Throughout the day, we do get Ward's auto sales in the U.S. Curious to see the pricing points as well as just the sheer volume at a time, where we heard yesterday from Ford that they are expecting prices to drop, that they are seeing a bit of a retracement from some of the enthusiasm, the euphoria in this industry. At 11 a.m., Fed Chair Jay Powell, everyone is listening in to both of his two opportunities to speak today in Atlanta. Will he push back on the market euphoria? Will he say, we're not going to cut rates, cut it out? Or will he say, we continue to monitor the data, we're careful, we're looking at everything, and, you know, let's carry on?
Maybe the latter.
Just
proceed carefully.
Yeah, proceed carefully.
For the 50th time this week. Does he have to clean up what Governor Waller said? Jeff Hugh of BNY Mellon insinuated he does, that maybe if Waller had another go at that, he'd edit what he had to say.
Well, do you think that the market move that we saw off the heels of Waller is problematic to the Fed's goals? Or is that not really affecting the economy to such a degree, and are the risks balanced enough that he doesn't really care?
They haven't shown any concern whatsoever about the easing of financial conditions. Whatsoever. They could come out and make a statement about the risks of the premature easing of financial conditions. I have not heard that from anybody. Even for that matter, from the Hawks on the committee, I've not heard that. They've not pushed back at all.
That's important to me. That's actually something that tells me that maybe they're not that worried, or they're more worried about the downside risk in the economy. And if that's the case, then Fed Chair Jay Powell does not need to push back as aggressively, which tells you quite a bit about where they see the softening going down the line.
Let's get to the opinion of Skylar Montgomery-Koenig, the Macro Strategy Director at TS Lombard. Skylar, let's go straight there. Chairman Powell a little bit later. Any different to what we've heard all week from Fed officials?
No, I don't think so. In terms of the last Fed meeting, we got this very dovish impulse for the market because we had yield rise so much that the Fed said that it could account for maybe a hike, and so they didn't need to do any more tightening. And from there, the market's really run with this idea that we're at the end of the tightening cycle. I think certainly we're at the end of the tightening cycle. We have inflation come down remarkably, and it looks like to the Fed that it's on a trajectory back to 2%. So for them, they don't have to worry about inflation as much. They worry about the economy more now, the other side of their mandate. And if FCI easing supports the economy, and it means they don't have to worry about unemployment rising, then why would it be something you'd fight if inflation is on the trajectory that you want already?
What's the bigger risk right now, in your view, Skylar, that we do get some sort of reacceleration in inflation, or that we get a faster than expected deterioration in the fundamentals of the economy, and we get a true recession earlier next year?
I think the bigger risk from a probabilities perspective is probably an inflation reacceleration. I think what we've seen in the last few years that we didn't see for the past decade was that inflation is more volatile. Geopolitics has come to be much, much more of a risk in terms of how it feeds into energy prices and inflation more broadly. And the consumer has been very resilient, and we're having real wage gains now. And so while I don't think it's my base case that we get an inflation reacceleration very, very high that starts to worry the Fed, probabilities-wise, I think I'm more worried about inflation coming back and a shock to the inflation trajectory than I am to the growth side of things.
Based on that risk being greater, in your view, than a recession, do you think that this market is priced to perfection in terms of pricing out that type of reacceleration in inflation?
I think, the market, if you look at long-term inflation expectations, it's a different thing than break-evens, right? So if you look at 10-year break-evens, they essentially trade what the oil price is doing. So they're not giving you a huge amount of information. But inflation swaps, so 5-year, 5-year inflation expectations that look at the longer-term trend, they've dipped a little bit more recently, but they've been on this upward trajectory despite the fact that we've had inflation coming down since the summer of 2022. So I think the market is looking for that. And, it is looking for the cuts on the back of it that imply a soft landing rather than recessionary cuts as well.
Skylar, given the moves we've had, the highly correlated moves we've had over the month so far, can you suggest for our audience where they might go for some kind of uncorrelated diversification, given that we've just witnessed a massive everything rally in stocks and bonds?
Yeah, it's really hard. This is the issue both in terms of the 60-40 on the up and the down, right? The reason you want to be in a 60-40 is because it provides you diversification benefits. If you're rallying at the same time as well as selling off at the same time, yeah, it's great. You can be allocated in both fixed income and equities, but it's not providing you diversification benefits. I think, the only other place to look is alternatives, both in terms of energy as well as the gold price. Gold is an issue right now because it's completely decoupled from where yields would imply it is, so it's very, very elevated. And then energy prices, you're stuck between the slowing global demand story on one side and then OPEC cuts on the other side. And so it's just a very hard environment. And, you have to look at those alternatives and kind of your real assets if inflation is the worry for the 60-40, but there's not a lot else out there.
Can you get some geographic diversification within equities? Have you seen any of that in the last 12 months? Is China the place to be?
I wouldn't say China. I think for us, we see U.S. exceptionalism continuing.
Okay.
There are 5 main reasons we see that. The U.S. is less exposed to manufacturing. It's less exposed to China. Industrial policy is favoring the U.S. And actually, it's in China, it's to the detriment of Europe. I think you've actually seen, the magnitude of tightening in the U.S. has been larger than elsewhere. But, what you've actually seen is that the tightening, I think, is, not as much as it has been in Europe. So, the other final thing is kind of your fiscal outlook. And so for me, when you're thinking about the U.S. versus other regions, the U.S. is going to continue to outperform. And then just on the China point, if you think about the world's global growth engines, it's the U.S. and China. China is an L-shaped recovery. You're bottoming in activity, but you're not rebounding. It's a consumer, domestic-oriented led rebound and stimulus. And so the Chinese economy isn't feeding into the rest of the world and developed markets in the way that it has historically or in recent cycles. And that means that the U.S. is your marginal provider of growth. So it's hard to beat that if you're getting any growth that you would get from there.
It's such a great point. The US keeps winning. Skylar, thank you. Skylar Montgomery, Koenig of TS Lombard. The US, Lisa, keeps winning.
Yay. I mean, this is the reason why we heard from Jeff Yu that we could see parity next year. I think about all the people who tried to go to Europe first, who tried to go outside of the U.S., and it was sort of the bold...
You're saying they should have waited until the next summer,
well,
if Jeff's right.
If Jeff's right, maybe we've got to push that out to 2025.
If you are just joining us, welcome to the program. Your equity story, the scores look like this on the S&P, pulling back by 0.1%. Yields a little bit higher by a single basis point, 434. Lisa, there's the FX market, a euro. 108.93, BNY Mellon looking for parity next year.
Yeah, and that really on the heels of the ECB cutting rates first. I do want to just go back to what we were talking about earlier with respect to Fed officials and how much they're going to push back on the market move. John Williams, who's really thought of as a key voice, New York Fed president at the Federal Reserve, said yesterday, "I'm not losing too much sleep over how markets have shifted their views." He doesn't seem to care, which raises this real concrete question about what the incentive is for Fed Chair Jay Powell to come out and push back against a market move that no one seems to care about, even though they cared about the other direction, right? Yields going materially higher, stock market selling off. That was a problem, and it could be tightening that overwhelms the potential rate hikes in the future. Not the other way around. That's important. That's telling us something.
They're responding to this asymmetrically.
Yes.
Yeah.
Correct.
No pushback at all. Coming up on this program, Bloomberg's Anne-Marie Hordern in Washington. AMA's just around the corner as the war between Israel and Hamas resumes. That conversation just around the corner. The broader price action, equities pull back just a touch by 0.1% on the S&P 500. What a run we've seen in both the equity market and in bonds. Stocks up, double-digit percentage point gains for the NASDAQ over the last month. In the bond market, yields aggressively lower, down 40 basis points plus on a 2-year maturity, down 60 plus on a 10-year. What disrupts this everything rally? Chairman Powell coming up a little bit later. From New York City, good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Tuesday, a special episode of Bloomberg Surveillance live from Apollo's headquarters. Join Tom, John, and Lisa for exclusive interviews with top leaders in finance, including Apollo's Mark Rowan and Jim Zelter, about the state of private markets, recession risk in the new year, and deal-making amid high interest rates. It's all happening December 5th, starting at 6 a.m. Eastern on Bloomberg. Context changes everything.
You're trolling folks and trying to find migrants to play political games to try to get some news and attention so you can out-Trump Trump. And by the way, how's that going for you, Ron? You're down 41 points in your own home state.
He's just throwing stuff out to see what sticks against the wall. This is a slick, slippery politician whose state is failing, people are leaving his state, and he's trying to run interference for his failure.
There's one thing, in closing, that we have in common is neither of us will be the nominee for our party in 2024.
What a debate yesterday evening, a sharp debate on Fox News. Governor Gavin Newsom of California, Governor Ron DeSantis of Florida facing off. Joining us now down in Washington, D.C., Bloomberg's Anne-Marie. AMH, you sat through it all. Walk us through what stood out for you.
Well, I think the first thing is that there's a lot of mudslinging between these two individuals. But I think the key part of what Newsom wanted to drive home, and he did it right at the opening there, is he wanted to bury Ron DeSantis as being the Republican candidate. So really, he was carrying a lot of water for Biden and Harris, kind of going into enemy territory here because he was on Fox News, even though he has some kind of special relationship, I think, with Sean Hannity, and you've alluded to this as well, John. These two seem to like each other, and Newsom's actually the one that I believe was at least a year ago called for the debate, saying, I'm happy to debate you, Governor DeSantis. So when he said neither of us will be the candidate for 2024, that was really the first shot thrown. But they covered a lot of topics, which we don't normally get in the presidential debates because there's so many people on stage and they're all trying to vie for their moment to shine or to have this breakout moment. Here they covered everything from abortion to taxes, the economy, crime, immigration. Didn't exactly get a ton of substantive debate, more just I don't like the way you're doing it and trying to defend their records. But potentially we'll see more of these, and I think it gives a little bit more insight of what we can see maybe in 2028.
A credit to Sean Hannity for making it happen. First of all, Anne-Marie, to your point on Governor DeSantis, what did he get out of that last night, going forward and trying to take on the former president?
So going into this, I really thought that Newsom, it was a win-win. He's going into enemy territory, so people on his side of the camp, Democrats, will say this is great. He's out there fighting the good fight for the Biden-Harris administration and their campaign. So he looks like a winner to his side, and he was elevated by the fact that Governor DeSantis is not just a governor, he's a presidential nominee. In some polls, he's second to former President Donald Trump. So it felt like DeSantis was elevating Newsom, and he didn't have to do that. Why was he going on a level with someone who's not even a presidential candidate? But I think for Governor DeSantis, this was a moment where he wasn't fighting other Republicans on stage to get his voice heard. He had a lot more time to explain his positions and speak directly to an audience that he wants to go out to vote. And of course, it comes 6 weeks before Iowa, where he spent a ton of money and a ton of political capital and time to try to win that primary.
Did they speak about foreign policy at all?
Foreign policy didn't really come up, a little bit when it comes to what's going on in Israel and the Americans there. But I would say this was framed by Sean Hannity to be a domestic debate. It was about red states versus blue states. And I'm wondering if potentially we'll see more, maybe Governor Abbott debating Gretchen Whitmer. Who knows? But it really was about how do you govern your state and the policies you're putting in place. And it started with, and I was preparing for this to start with because this is what Sean Hannity started his sit down with Gavin Newsom. Prior, it was about the migration we've seen out of California, people leaving California, which for the first time ever happened in 2020. And of course, Gavin Newsom became governor in 2019.
The reason why I ask Anne-Marie is partly because it seems like President Biden is fighting in his race much more on a foreign policy perspective right now. There seems to be a real shift in tone when it comes to Tony Blinken, what he said to Israel over the weekend. Now what we see in terms of what the U.S. is saying about Israel's actions in the reignited conflict, in the reignited war between Hamas and Israel. What do you make of that, and how much is that really kind of where President Biden is in terms of how he moves his campaign forward?
Well, this is what the administration has to deal with, less so the campaign at the moment. But the administration is dealing with two conflicts in the world right now. And obviously, you have Secretary of State in the Middle East, and you have a resumption of the fighting, so that the pauses we see, the tactical pauses or truce, whatever you will, for a week long, that we've seen hostages out of Israel and prisoners, hostages out of Hamas's control back to Israel, and prisoners in Israel being freed, that has come to an end. So this is obviously going to be front and center for this administration. And it's a good point, Lisa. We did see a much tougher tone from Secretary of State Antony Blinken. Nick Wadham said to me yesterday, it was almost like he was airing to the press that he had read the Riot Act to Israel's war cabinet, saying the mass amount of civilians we saw in the north cannot be done as it is widely expected for the Israelis to go into the south part of Gaza.
So let's talk about policy. For a lot of people from the outside looking in, there is a clear and obvious division within this government between the president and perhaps within people within the State Department. Anne-Marie, that's just the government. And then you've got a massive split in Congress within the Democratic Party. So can you talk to me how on earth we come up with any kind of agreement early next year to give aid to Israel, to give aid to Ukraine? What is that going to look like in the next few months?
Yeah, it's a great question, and we heard Admiral Kirby talk about this because really for Ukraine, they would need something to be done before January, before it starts to become a little bit more of a dire situation for Ukraine, because those funds that the president can draw down on are dwindling. You know, we don't have a vote yet in the Senate. The Senate is working on a package that would encompass all the foreign policy concerns, but it would have to also include something on the U.S. southern border. And the thinking here is the way you can get more individuals in Congress to sign up for aid to Ukraine is to make sure that there is work that's being done and aid sent to the U.S. southern border. But the timeline is tricky. I mean, the biggest story for Congress today is going to be whether or not they expel George Santos, the representative from New York's 3rd Congressional District. But they don't have a lot of time left. So if this lingers into early next year, it could be quite problematic. The other big debate when it comes to Israel in Congress is whether or not they want conditions attached to that aid that the president asked to send.
AMH, appreciate the update down in Washington, D.C. Anne-Marie, more from AMH through today on Bloomberg TV and on Bloomberg Radio. Bramo, before we get lost in the glitz of a presidential election next year.
Glitz?
Before we get there, all the headlines, all the attention, the big crowds, we've got to focus on making policy at the start of next year. We've got to find some kind of agreement over spending, good luck, some kind of agreement over sending aid to Israel, given the split within the president's party, that's going to be difficult, and then some kind of agreement over providing aid to Ukraine, which is a war which hardly gets talked about now in this country, given what's happening elsewhere.
You know, this is sort of the unspoken secret, but very well known by everyone, that in all of these campaigns, the uglier and more contentious they've gotten year after year, nothing's actually getting done in terms of moving forward certain important policies, including, for example, you know, coming up with actually good cost cutting that can reduce the deficit, that comes up with a coherent foreign policy that a lot of people, critical mass, can get on board. And it raises this question, especially with a House that's been in disorder and that still is sort of has tenuous leadership, a question of what can get through, right, at this point. So yes, you raise a point. We have to get things done. But do we? Because it really hasn't been a problem going back. I mean, it's just sort of a can-kicking exercise for a number of years.
Deficit problems don't go away just because rates have gone from 5 to 4. They just don't. The
They're a
numbers
lot
are
less,
huge.
though. I know,
Sure,
no, I hear
but
you.
the numbers are massive.
They are massive.
They're massive.
And they're not necessarily going to be making cuts anytime soon. And the truth is, whether it's Democrat or whether it's Republican, any kind of proposal that comes out to cut costs, nothing actually addresses the main cost absorbers. So it's not clear that there's going to even be the conversation unless there is some sort of bipartisan effort to really tackle this head on.
Granted, it's better that it's not at 5. And
I was
it's
going to say, I mean, how many
I'm with
billions
you.
and trillions
Sure,
did
a
it
lot.
reduce from the
Based on
next
how
10
much
years
debt
of interest payment?
we're issuing at
Yeah.
the moment. That's a
Makes everyone
big
much better.
saving. Coming up shortly, Kennedy Goldberg of TD Securities on interest rates. We'll be talking about this equity market rally as well. What a rally through the month of November. Equities right now pulling back just a touch. We're down 0.1% from New York. This is Bloomberg.
The reception, the acceptance of Purosangue has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Purosangue all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Equities pulling back, down 0.1% on the S&P 500. Who cares after the November we've just had? I said yesterday, I think equity bulls just did not want last month to end. Just let it continue, November forever.
I mean, it felt like forever, so, maybe
Double-digit percentage point gains on the NASDAQ 100. down just 1/3 after a monster move last month. Biggest move since the summer of 2022. On the equity market, on the S&P 500, again, biggest move since the summer of 2022 on a monthly basis. I will say on a weekly basis, though, this NASDAQ move has stalled a little bit. Just slightly negative, Lisa, on the week.
And I'm sure people are crying because some of the 500% gains on NVIDIA are now 498. But here's the thing. I mean, honestly, one of the reasons why I'm always a skeptic, right? I like being a skeptic. I sort of question things.
We love you for it.
Thank you. But part of the problem is that, there is actually some numbers. There are some numbers that underpin this. And actually, some of the tech companies seem to have real promise and are cash cows. So it's harder to push against this and say it's simply euphoria or a dot-com bubble in the same kind of way. So you don't really hear that type of discussion as much, even after something that seemed implausible just a couple months ago.
NVIDIA's making real money.
Exactly.
Put it that way. Top performer on the S&P. Real money. This bond market move, though, what's changed? From 526 on a 2-year last month, from 5.02% on a 10-year last month, down to 469 and 433. What's changed, Lisa, in a month?
Disinflation data, the fact that people feel better, maybe that there was enough stability to get all of the long-term buyers to come back. It is notable to me that some of the buyers, like Ian Lingen, like Bob Michael, were really bullish on bonds, but weren't getting into them because they didn't have the confidence of the technicals behind them. So maybe yields came in, everyone bought, and then yields came in further. So the narrative changed, the mood shifted, we all feel better. Does it stick?
Price changes narrative pretty quickly, right?
It
Quite
does.
fast.
It does, yes.
It's been quite a shift in the last month. I'll finish on foreign exchanges. Yields dropped. The dollar's had a tough one the last month. The dollar's had its worst month, going all the way back to last year, I believe. The euro, decent month, 108.96. But for how long? Pulling back recently, and we caught up with Jeff Yu of BNY Mellon. They're talking rate cuts over in Europe now, and Jeff Yu's saying, guess what? ECB goes first. And as they go first, hello parity all over again on the euro. As soon as he said it, I was sitting there like, wow, okay, we're doing that again?
I didn't have really a good response. I was just sitting there saying, that's a bold call. What was going to back it is interesting to me, the idea that the ECB could potentially cut first. And we had 3 guests on this show this morning who said that they believe the ECB is going to cut rates before the Federal Reserve. And this comes when just a couple months ago, people were saying the ECB was on hold until 2025. There has been a shift in the data and a shift in the narrative showing faster disinflation than many people expected, both in the US, but also in Europe. And that has shifted a lot.
It reminds me of a conversation 10 years ago. I remember the summer of 2014, and we were talking about who would hike first, Carney at the Bank of England or the Federal Reserve. And we were convinced after he did this speech that it would be the Bank of England, and it wasn't. It wasn't. Sometimes you can be very wrong about these things. Maybe we'll be very wrong again. Under surveillance this morning, Israel resuming its war against Hamas after efforts to extend the truce failed. Secretary of State Antony Blinken was in Tel Aviv looking to extend the agreement when fighting resumed. Blinken also met with the president of the Palestinian Authority during a visit to the West Bank. Blinken will remain in the Middle East as he heads to the UAE for COP28. We've been talking about a fragile truce. It was exactly that.
Yeah, especially after each negotiation lasted longer and longer, and there were questions about how many of the hostages are still alive. Going forward, there's going to be a key question around where the sort of pressure comes from in terms of global leaders and how they're trying to maneuver behind the scenes, because right now it seems like for Israel and Hamas, the objectives are clear, and the objectives are to continue this war. But with respect to what some of the other players want, particularly the Middle East, they want stability, and the U.S. President Biden wants to get reelected and is trying to figure out how to do that. So that's sort of the counterbalances here.
We were in London in September. We caught up with some oil guests. Triple-digit crude by Halloween. Do you remember the calls?
Yes, I do.
That was September. Then you get an extra layer of geopolitical risk in early October, and people are thinking crude's going higher. October, down 10.76%. November, down by 6.25%. Crude, lower, back into the 70s and maybe going even lower than that. Oil traders totally unimpressed by the latest moves by OPEC Plus as voluntary cuts failed to boost prices. After its virtual meeting, OPEC announcing an optional cut of 900,000 barrels a day from January. Saudi Arabia extended the current 1 million barrel a day cut through the first quarter of next year. And here in the US, output hitting a record high of over 13 million barrels a day for the month of September. So Lisa, this word voluntary seems to be the word that a lot of people are fixated on. These are so-called voluntary cuts. Does that mean they don't get delivered?
Yeah, well, I'm sure that somebody else can answer that better than I. This was a meeting that was delayed by 4 days. It was then virtual. And then they came up with language that was highly confusing amid a lot of questions around Angola and Nigeria and their ability and willingness to meet some of these thresholds. Right now, the pressure on cuts, though, raises a bigger question, which is oil still the barometer for global growth that it used to be, given that certain modes of energy are really shifting? And if so, whose energy demand? Is this really just a barometer on China, given the fact that the U.S. is getting increasingly energy independent based on how much production is coming out here?
Without a doubt, output in America is just amazing to see, and amazing to see the White House sort of like
dance around
not talk about it at all. Crude lower over the last month. Pfizer lower this morning. The stock is down by almost 4%. The latest on that company this morning, the news there, stopping development of its experimental weight loss pill after side effects forced more than half of the patients, more than half, taking part in a study to stop taking the drug. Pfizer, of course, has fallen significantly this year as the pandemic fades. The weight loss drugs made by Lilly, Novo Nordisk, you can see the gains, Bramo. Lilly up by 61%. Year to date, Novo up by 47%.
Yeah, and yesterday, what did we hear? Ozempic is the new artificial intelligence in terms of
new AI
transformation.
The new boom.
Yeah, it's the new boom. At a certain point, though, how much can we really innovate? These were pills, not injections, and that's the reason why people had hope for them, because people could take them more easily. There are a lot of potential risks here, and we've heard this again and again. Ozempic face, different types of side effects.
What's Ozempic face? What is that?
It's when, like, you lose a lot of fat from your face,
like
and then
gaunt.
it gets gaunt, and then there's sort of wrinkling under the eyes. I was looking at this yesterday. I heard about this. I'm not the expert on this. We're going to be speaking with Sam Vazzelli later. He can explain what Ozempic face.
You said it, so I thought you'd explain it.
I'm going to let that hang there.
Sure. Gennady Goldberg joins us now, head of US rate strategy at TD Securities. Good morning.
Thanks for having me.
Gennady, let's talk about what's happened in this bond market. Can you tell us, please? I get the price change. We can look at a chart. What's actually changed fundamentally to get us here?
I think it's the data. You know, I think all of 2024 is going to be this struggle, especially in the early part. It's going to be this fight between supply and demand, which we know is still very much out of balance, and the market's sort of forgotten that at the moment. But the data has turned, right? You're starting to see soft data, hard data, inflation data, all surprising to the downside. I think that's the big driver, and the market's gotten into its head that no hikes equals cuts. And I don't think that's quite right. Speaking as a bond bull, at least recently, you know, we've been long since 470, and I'm certainly not complaining, but I do think you are seeing a little bit of an overstretch at this point. The market's not really thinking about that the data can be, you know, less than bad. And if you see some strong data, you can certainly have a problem there.
Let's push that a little further.
Yeah.
What would make you not be a bond bull anymore? How far would this have to go?
I think if we got closer to 4%, I think I would take my foot off the gas pedal at that point. You know, you have to play this one tactically. You know, for the next year, yes, we expect rate cuts. Yes, we expect the data to slow. We expect a recession by the second quarter of next year. Not yet, right? This market's getting really ahead of itself. What you're seeing is a massive compression in term premium, which is very interesting to me because that's not something you typically see at this point in the cycle, especially when a month ago we were talking about who the buyers are going to be, right? Who's going to be taking down all of these trillions of dollars of treasury supply. Suddenly that's gone, and term premium has dropped over 50 basis points just in the last month. I think that's a little bit out of whack.
Which is the reason why we've been talking about the difference between 2-year yields rallying as much as they have and 10-year yields rallying as much as they have. Do you have more confidence right now in short-term bonds or long-term bonds?
I have a little bit more confidence in short-term bonds. I do think that 2 to 5 year sector is pretty attractive. From a long-term perspective, I think folks are certainly getting in, which is why you're seeing that. But you're also seeing this massive repricing and rate cuts. And yes, you know, we do have cuts next year, but again, it's going to take some time for those to actually filter through. And for that data to actually catch up to reality, you're not really seeing that at the moment. You're seeing something slow down. You know, let's say we get a 250K payroll print next month. You know, what's going to happen to rates? I can easily see us back up, you know, 15, 20 basis points just on the day.
We're going to do some scenario analysis over the next week. That will be the number one question I ask.
Oh, yeah.
What if we get 250? How does it change this bond market? You mentioned the deficit. Still massive.
Yeah.
If you can pick out the chart of what's happened with treasuries, I think you can closely identify what happened in the summer and what happened in the last month. Treasury refunding was kind of important. Now, Mark Dow is a man who I really respect. He's out on Twitter, now known as X, of course, and he talked about confusing a catalyst with a driver. Now, you could probably identify Treasury refunding as a catalyst for the turn in this market, yields up, and again, yields lower. But is that the driver of what we're seeing take place?
I think the driver's still the macro. I think it's more so the catalyst is only paid attention to when there's nothing else going on, when the data is good. That's what matters. Supply matters when things are good, when you have your choice of, the pickings, whether you can buy stocks or bonds or corporate bonds or whatever you want. When data starts to turn sour, people stop caring. It almost doesn't matter how much we issue. People want to get into safe haven assets. They know rates are going down. They're trying to make the macro play. So it's almost kind of, supply on, supply off. But we keep getting these, prints that are basically telling us the bond market's not very healthy, right? You keep getting these 5 basis point tails at 30-year auctions. It's going to be a problem for the U.S. Treasury. So speaking about catalysts, the next one could be quite interesting. If we get another 1 or 2 tails at these, 30-year auctions, maybe by February, Treasury will decide not to increase 30-year auction sizes anymore, and that could be quite bullish as well. But it is going to be whippy.
We've been talking all day about how exhausting this year has felt. We've been talking all year about that, and how November felt like a year in and of itself, which raises a question. Do you end up going into next year, the way Chris Harvey is talking about it over at Wells Fargo, which is just treat it as a trader's market, lean against sort of the sort of momentum trades, try to sort of lean against the flow, and we're going to end up in the same place that we are right now. Is that kind of how you're looking at it?
A little bit. I would say lean with the flow and just be very careful about how far things are going. Realize, I think, that there's a lot of people on the sidelines, that people are piling in very last minute. So when you get that perception that, things are going a little bit too far, you want to start taking some risk off. You don't want to lean into long-term calls, very stubbornly at this point, because you do want to realize that people are going to be getting in late in the cycle, and you're going to be exacerbating a lot of these moves. So where you should have been going to, let's say, 450 on 10-year rates, you're now going closer to 4%. That's your symbol. I think that's your signal to get out if the macro doesn't support it. Keep an eye on the macro and keep an eye on the momentum, because those two are really going to whip things around.
Just how sticky is that money in money market funds?
I think pretty sticky until something really material changes. I think a lot of that money will pile into equities, will pile into fixed income at the first sign of trouble. Right now, it's still piling in. Right now, it's still
So November wasn't it?
No, I don't think so. If we continue to get really decent macro data, why not? People are still going to be earning, 5.25% to 5.5% on their money market funds. It's, duration free. You don't have to worry about losses. It's a very easy play unless something looks attractive. And the issue is right now, not a lot of things look especially attractive from a long run.
If you are just joining us, welcome to the program. Just an update on the scores right now. The equity market negative on the S&P 500 by 0.1%. Let's continue that conversation because I think it's really important. There is a view, I think, because we've been conditioned by 2 massive shocks and 2 massive policy responses to those shocks, Great Recession, financial crisis, and then the pandemic, that when the Fed starts to move, they go all the way back to 0. What do they go back to?
We think around 3%, and that's kind of a short-term neutral rate, and I think that is in their minds as well. That's the next fight for inflation, right? If they go back to 0 and they do QE, we're going to be in for another huge round of inflation, and they know that. So they have to almost under-ease in the next cycle. We're thinking they go back to about 3%, so that's 250 basis points of rate cuts by early 2025. That's what we've got penciled in. If that's the case, and they're going to be very cautious about it, they're going to basically ease, but they're not going to ease excessively. They're going to get us right back to neutral, maybe a little bit below neutral in the short term, to just stimulate the economy, make sure they're not over-tightening. They don't want to ease massively. They do not want to go back to 0, even more than they don't want to talk about rate cuts.
They really don't want to talk about rate cuts, do they, Brahma?
No, they absolutely are going to avoid it, except Chris Waller, who kind of went there.
He kind of set it up, didn't he?
Yeah,
I do wonder about Waller this week. How much of that he really wanted to say? Maybe it was what he was thinking. Is it what he wanted to say?
But the fact that he's not losing sleep over the market's move.
Yeah, I think that's important.
Really, it is important. It tells us that the balance of risks is they are seeing a greater risk of weakness.
Gennady, great to see you. Gennady Goldberg there of TD Securities from New York City this morning. Good morning. Your equity market on the S&P pulling back by 0.1% on the S&P 500. From New York, good morning.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg. Top experts. Great questions.
Magnificent Seven have had a fantastic growth year. I mean, one semiconductor company has massive growth. If you take a look at the next 9, they don't. So when you think about valuation, I'm really not taking an active bet against large cap tech to really underweight or overweight.
That was Steve Whiting there, the chief investment strategist and chief economist over at Citi Global Wealth, on some of the big winners of the year. The big winner of the year, of course, has been NVIDIA. And I think everyone wants association, Lisa, with that story.
Yeah, anything to build on it, to build on the software side, because they are the hardware solution of choice. And then really what people are talking about is how hard it is to get into the hardware side. So you might as well be the software side and pair with it and just ride the train.
Let's have that conversation right now. Computer hardware maker HP Enterprise joining the rush to artificial intelligence. In earnings announced this week, HPE saying it expects softer demand for servers and storage, but it's hoping its new AI venture will offset the slowdown. The plan including a bigger partnership with chip giant NVIDIA. Antonio Neri, the CEO of HPE, joining us from Barcelona, where he's been speaking to customers. Antonio, great to catch up with you, sir. Let's start with that relationship with NVIDIA. For our audience who aren't familiar with it, can you describe it to us and how beneficial it's going to be to both of you?
Yeah, well, good morning. Thanks for having me. As you see, we are in Barcelona. There's still a show going on. We hosted HP Discover here with more than 3,000 customers. Thanks again for having the opportunity to talk to you. So here at Discover in Barcelona, we announced an expanded partnership with NVIDIA. 2 weeks ago at the supercomputer event in Denver, we announced a deep solution for what we call model developers for generative AI, using our supercomputing capabilities, plus our intellectual property in the software space, plus NVIDIA chipsets, and other aspects of what they do to provide a massive capability for model developers to speed up the training models. And here on Thursday, I announced an extension of the partnership for enterprise customers to what we call fine-tune those models and accelerate time to value, using our expertise as well as our services capabilities and the software to be able to deploy it on premises and at the edge. So this is a complete solution for what we call the AI lifecycle, from training to tuning to inferencing. And customer has a massive reception because they want to privately fine-tune the models with their data in a secure and compliant way.
It's clear your stock is benefiting from the glow of NVIDIA. We can see that. I think Raymond James writing that you're getting a seat at the AI table. Can you talk to us about the pace of adoption of this technology? I think many of us, Antonio, are surprised by some of the guidance we had repeatedly from NVIDIA, that this wasn't just a hopeful story about the future, it was real and present. Can you talk to us about that?
Yeah. Well, I think there's 2 components, right? So the story is absolutely real. We see it in the quality of the dialogues with customers, which are now accelerating the model training. So you think about this, at the beginning of 2023, we had less than $100 million, what I call accelerator processing units in our server business. At the end of 2023, we grew that business to $3.6 billion in orders. And that was literally in 10 months. And the reason why that's happened is because the technology has achieved an inflection point where it's ready to be deployed. However, our story is not just AI, just to be clear, Jonathan, Lisa. Our story is a combination of a hybrid cloud, a cloud-native world, and an AI-native world. Think about it this way. Most of our data today sits in the cloud-native world, whether it's in your premise, in manufacturing floors, in hospitals, and obviously in the public cloud. But AI needs that data, is hungry for that data, and therefore now we need an AI-native architecture to train and fine-tune these models with that data and then put it in production, which ultimately is the value to change your processes and be able to achieve those outcomes. And we deliver all of that to our HP GreenLake platform. And that's where we see a tremendous growth in our connectivity business, in our hybrid cloud business, and then obviously now in AI. And we have a unique portfolio to address all aspects of what customers need.
Antonio, this year we've been talking to so many people who talk about a winner-takes-all type of trend in tech in particular. Amazon's AWS, Microsoft's Azure taking an increasing part of the market share. How do you compete at a time where people seem to be gravitating toward the biggest players?
Well, there is an interesting opportunity here because obviously the last decade, think about 2010 to 2020, was all about the cloud decade. You know, the cloud for us is an experience, is for accelerate speed and agility across the business. And now we enter what I call the new age of insights. And it's all about deriving insights from the data and changing the way you do business. But that inflection point actually requires a different architecture. And therefore, customers are not keen to put the public data, the data in the public domain, and make sure that they control that because that's the intellectual property. And that creates a massive opportunity for us. And we think of HP GreenLake as the fourth cloud. It's a design for hybrid, meaning you can take advantage of the public cloud, but also take advantage of your own premises and more at the edge, and be able to do everything you need in a unified experience. And that's the value that we bring to the table. And ultimately, we have every aspect of the solution stack and the partnerships, like we did this week with NVIDIA, to give that unified experience.
We've been hearing all about consolidation in big tech. How much are some of the biggest cloud providers trying to get into that market where it's basically the hybrid, trying to have bespoke solutions for companies versus having the market to yourself?
I mean, the market is big. I think, we're talking about over $1 trillion market opportunity from an IT perspective. And I believe AI opens an incremental $1.6 trillion opportunity for everyone. So there is plenty of market out there. And you think about us as a company, this year we grew 5.5% in revenue. We expanded gross margin very rapidly thanks to the mix and the value we bring to the table. We achieved record-breaking performance in non-GAAP, diluted net income per share, and free cash flow. And we believe there's plenty of runway here. But ultimately, the winner is about all delivering a simple experience where technology is easy to deploy and consume, and ultimately accelerate business outcomes. It's not just about thinking about technology and speeds and feeds. It's about delivering that agility to deliver those business outcomes. And I think HP is uniquely positioned with the fourth cloud, I call it, HP GreenLake.
Too much tech. Let's finish on football. Are you happy that Messi is no longer in Barcelona and we have him here in America now, Antonio?
Well, I'm happy that Messi is Argentinian, and I was born in Argentina, and I had the honor and pleasure to meet both of them. In fact, I was able to play one time again with Diego Maradona, and I have to say, for us, it's an incredible pride. But obviously, having him in the United States gives me the opportunity to go watch him more often.
Amazing. I want to hear that Maradona story one day. Antonio, thank you. Antonio Neri there.
Thank you for having me.
If you look back at, thank you, sir, on the latest. Just got a note from Citi I want to share with you all just quickly on the pushback we can expect from Chairman Powell a little bit later. Just in summary, Lisa, not much of a pushback.
Yeah.
Andrew Honhorst says over at Citi.
And this is partly because, frankly, he hasn't. And he basically will say that they're not indicating any discussion around rate cuts, but it's not going to be the massive shutdown, the throwdown with the market saying, guys, stop it, because it doesn't seem like they care that much about the loosening in financial conditions.
No, not at all. And they did care, big time, 12 months ago. I always go back to that speech. Chairman Powell, Jackson Hole, August 2022. We'll get inflation down. It might be painful. It'll be more painful if we don't. And we're still sitting here saying, okay, where's the pain? Where's the pain? That's what has surprised so many people, to see inflation come down the way it has done without the economic pain. I think what's interesting about the last month we've just had a 60 basis point move on a 10-year yield. It's the biggest monthly move going back to March. But March, as we indicated on this program a little bit later, was about hard landing nirvana. And the last month has been about soft landing nirvana. And the pushback against the soft landing stuff that you hear all the time is that it always looks like a soft landing until it's a hard one. Chris Mamani, Lafayette College, yesterday.
I heard that.
Brilliant,
that was great.
Brilliant. Came out with this line. He said, yeah, but John, it also looks like a soft landing when it's a soft landing. So who knows? What did Neil Dutta say? Glide path. He talked about a glide path, right? He thinks we're on a glide path to rate cuts.
As soon as March. That's right. To me, it seems like November was the month that we reprised transitory without saying transitory. And to me, it seemed like we pushed back a lot of the expectations from the end of last year. And to me, transitory is sort of the subtext to all of the moves that nobody will ever say because it has been dragged in the mud and tarred.
Transitory for longer.
And basically that the period of time where inflation was elevated lasted longer, but that ultimately we're going to go back at a year-over-year comp basis. Nature is healing. All that.
I get nervous when people start saying things like that, but yeah, that has been the last month.
Yeah.
Let's just say that's a judgment about the past and not a call about the future.
Are you trying to do the fine print?
You're
doing the fine print on the bottom?
Absolutely.
I think that's right.
Just a small disclaimer there. Coming up in the next hour, Liz Young of SoFi to weigh in on this market. This market right now, equities negative by 0.2% on the S&P 500, pulling back just a touch after a monster move month today on the NASDAQ. Closing out the NASDAQ for a double-digit percentage point gain. Can Chairman Powell spoil the party as we kick off December? Chairman Powell coming up a little bit later.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffman also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Inflation is coming down faster than they expected. We think that the Fed's last rate hike was July.
They're going to want to be careful about having restrictive monetary policy.
A policy error would be that they tighten policy so much that inflation falls too much.
I do think that the data is lining up, and we're on a glide path now to a rate cut.
Well, it's not that the Fed can't ease next year. I think the debate right now is when are they going to ease.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Music to the ears of equity market bulls from Neil Dutta there for Renaissance Macro on a glide path towards rate cuts from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Your equity market pulling back just a touch by 0.2% on the S&P 500. The everything rally has absolutely dominated everything on this program, Lisa, for the last month.
And we keep repeating this one stat, 9.6% gain on the 60-40 portfolio put out there by Bank of America, Michael's Hartnett. The biggest gain going back to the dissolution of the USSR in December of 1991. It gives you a sense of history and how unusual this type of move really is, John.
How far can this move go now? Mike Schumacher, Wells Fargo, on a little bit later. He thinks the limits to this 10-year move, 4%. 4%. 4% is like maybe a day's price action based on the moves we've seen over the last week. 10-year right now is 4.33. So if Kelsey Barrow's right over at JP Morgan, that was the last hike back in July 26th, 387 at the close on a US 10-year, 387. So now it really is about, do you see growth and inflation continuing to fade? Do you see this Federal Reserve cutting anytime soon?
I thought that Gennady Goldberg put it really well, where he basically said that we're being whipsawed between the economic data, which has come in weaker than expected when it comes to certain economic indicators as well as inflation. And then you also have just the momentum trades that are whipsawing things to take them further than people previously expected. So now, do we hear more about levels, thresholds, things like that people are using for triggers? What this says to me is we're going to be in this bouncing kind of sphere for a while. We're not going to get back to that sort of direct trade that's going to last more than a month or two.
I think there's a chance we're confusing a few things. Savita Subramanian of Bank of America said it's not about what the Fed's going to do, it's about what they've accomplished. And I don't think it's necessarily about the weaker economic data. It's what the stronger economic data didn't do. So that you can have a Q3 with GDP north of 5% and inflation doesn't accelerate. That you can have unemployment still below 4%, jobless claims around 200K, and wage growth isn't going through the roof. That you can have this very, very decent, in fact brilliant, rebalancing of the labour market, supply and demand, without a recession, without a big economic downturn. That is what I would argue this market has celebrated. Now, whether that continues, I've got no idea whatsoever. But I think it's a stretch to say that we're seeing weak data. I don't see weak data. I don't see that on the surface at all. It's what I don't see off the back of strong economic data. This US economy has been so much better this year than people expected, and yet inflation. If I said to you, start the year, Q3, north of 5% GDP, what's your CPI call?
CPI call would be north of 5%.
Okay, you'd expect inflation to be high. That's not what happened. So when Neil Dutta of RenMat came on the program, I think a number of months ago, maybe a number of weeks ago, and he said the important piece of this now is the labour market is no longer a reason to be hawkish, based on the very fact that you can have 200K prints on payrolls and wage growth isn't going off into the stratosphere.
There's a lot to unpack there, and I think you're right in the sense that people are celebrating the fact that stronger economic data has not caused a resurgence in inflation. At the same time, I don't think anyone's too comfortable with the idea that we're not going to see that, basically, especially because of the year-over-year comparisons. There is a sort of unprecedented feature to everything about this cycle, not the least of which is, yes, we haven't seen weakening, but on the margins, people don't feel good. And on the margins, people are restricting spending. And on the margins, we do see ongoing recession in the manufacturing sector, ongoing recession in a lot of the smaller companies. So when you take a look at that, it's sort of masked by a lot of strength in the adoption of all of these other things in the AI. If it sounds like a mush, it feels like a mush, and it's the reason why I think there's a lack of conviction, frankly, in the market.
Just remember, it was price gouging. All right, that's all it was. Can we get to that statement from the president? I need to do that again.
Please.
I think it's brilliant.
It is.
Who writes these tweets for the president of the United States? That's all I want to know. Who writes these tweets for the president? There's no way that President Biden is sitting there on an iPhone whacking these out. There's just no way at all.
Well,
what does this even mean? Let me be clear. To any corporation that hasn't brought their prices back down, even as inflation has come down, it's time to stop the price gouging, give American consumers a break. I mean, talk about politics and bad economics. Jim Bianco, apparently he does not know the difference between prices rising at a slower pace and prices falling. It signals he does not listen to Secretary Yellen because she knows the difference. That take from Jim Bianco implies that the president wrote it. I don't think the president wrote it. I'd love to know who did.
Well, to me, we'll try to find out that answer. Probably unlikely that we will, but to me, the real issue is, what does this signal about the desperation to try to push the blame of inflation onto someone else? Because he has gotten the blame for inflation. Not saying it's necessarily warranted. A lot of people still debate exactly the drivers of inflation, but right now, it seems like this is impeding his re-election bid more than anything else, and he's not sure how to tackle it. And that's what that tweet says to me, because a lot of people are ex-post. You know, a lot of people would just, you know, categorically say it's nonsense.
Ex-post means something else, doesn't it?
Well, it could.
Yeah, it's sort of ex-ante, ex-post. But yes, it's a post on X.
Thank you.
I'm with you.
Yes.
Let's get to the scores.
Excellent.
Yeah, TK would have appreciated that.
I thought that was good.
Whatever.
I got it.
Futures on the S&P,
Right there with
negative
you.
by 0.2%. We're coming back just a little bit softer, negative down lower on the S&P 500. Yields going nowhere, 432.81. Yields going somewhere, and that's lower over the last month. A monster move in bonds and stocks. The everything rally dominating the month of November. Let's catch up with Liz Young, Head of Investment Strategy at SoFi. Liz, any reason to believe, and good morning, it's always great to catch up with you, you know that, any reason to believe that this bond market, stock market correlation continues in the way it has done over the previous month, over the next 3 months?
Well, it's certainly possible. I mean, I think 2023 has shown us that anything is possible. So it's certainly possible that the correlation remains positive in the sense that we continue to see yields come down. Stocks are celebrating that, particularly growthier stocks, which I think is a rational move, at least initially. So I do think that the correlation could stay positive for a little while. What we're looking at here, especially into 2024, is that we've been wanting cooling in a lot of this data. We've been wanting the cooling in inflation. We've been wanting a labor market that gets a little bit more imbalanced. So we've seen some of that data, things like continuing claims on a steady move upwards since September. We know that the manufacturing economy is still feeling some pain. We're hearing data out of the consumer that they're pulling back on spending a little bit. So we've wanted this cooling. The question into 2024 will be, can we stop the cooling before the economy tips into contraction and makes us all nervous? If we start to get data that gets too cool too quickly, that's when that correlation between stocks and bonds breaks down, where I think you see bonds rally. So you see yields continue to fall because people got afraid, but stocks also come down in tandem.
Liz, you work for SoFi and you work on the investment wing of it, not necessarily on the financial technology aspect that caters to usually younger individuals who are trying to manage their finances and take out credit. I'm wondering, though, what you make from an economic and investment perspective of people who are doing more buy now, pay later, who are increasing their credit card bills, who are increasing on their delinquencies and their defaults.
It's certainly concerning, and it's something that I've been watching for the last few months. We've seen delinquencies tick up so far in just the subprime auto loan sector, but you've seen, as we all know, credit card debt get to really high levels. Hasn't broken yet, hasn't been an issue yet. But the thing about where we are this time of year, we talk a lot about this being a positive time of year for the market. And as we all know, the Santa Claus rally, a possibility later this year. And we've got holiday spending going on. And so far, the data from holiday spending has been maybe a little bit higher than expected. However, what happens in January and February is that if consumers were doing that holiday spending on credit, so things that like buy now, pay later, or on credit cards, the bill comes due in January and February. Now, this happens every year, but this year could be a time where we're seeing that bill come due and delinquencies tick up because consumers have been using buy now, pay later in larger quantities than they did last year.
How does that affect your investment strategy? I mean, basically, are you looking to January and February to see those increase in defaults in order to get more bearish and say that maybe the bond market could rally more, but that's going to be a negative when it comes to equities?
Well, so the bull case and a lot of the optimists have been hanging their hat on the strength of the consumer, and the consumer has remained strong. There's obviously appetite to spend. There's appetite to travel. We're seeing the consumers still get out there and spend their money both in stores and online. But over time, if the labor market cools, or if consumers really are feeling the pain of inflation and recognizing the idea that inflation has stopped growing as quickly, but it hasn't come down. So for consumers to really get some relief, you would need some deflationary prints, and we haven't gotten those yet. So if the data does start to suggest that the consumer has pulled back, or the labor market is cooling to a point that's going to cause the consumer to pull back, then that is going to be negative for equities, particularly from these levels. So watching that on a sector basis, though, it may not be a wide swath of a drawdown, right? So if yields are falling, tech stocks probably still can do okay in that environment. But then you see the pain on things like consumer discretionary stocks. You see the pain on cyclicals, because right now I think the market is in this place where we're not sure if we're going to have a cyclical expansion or not. We haven't confirmed in one direction or another, and we're sort of waiting to see.
Super difficult to make calls on this market. You mentioned sectors, Liz, so let's finish there. What are your favorite sectors going into year end and beyond?
Well, look, as yields fall, I think for the near term, at least, tech stocks still can hold up well. This is also a period of time after the last hike and before the first cut that stocks tend to do okay. So I don't necessarily see a huge drawdown unless there's some exogenous shock. But going into 2024, I think that we need, if the bull case comes true, we need some broadening out in the equity market. I am still nervous about a drawdown. I am worried that we're going to get data that cools it too much. So I would be cautious in cyclicals. So I would still be looking at things like consumer staples. I think the utilities trade is okay. If you're looking for growth, but you don't want that rate sensitivity, I think healthcare is a good place to be. And I do think that we see a resurgence in energy stocks because supply will continue to get cut.
Interesting final point. Liz, thank you. It's good to catch up with you as always. Liz Young there of SoFi in this equity market. In Stuart Kaiser's corner over at Citi said much of the same thing. Be careful what you wish for. When the economy starts to slow down, the data goes too far, then he's going the other way, in the other direction.
Which is essentially JP Morgan's call, and they're going to be pilloried because of how far they're going with exactly the 4,200 price target. Nonetheless, the rationale is actually pretty consistent across Wall Street. It's just a matter of how that translates to markets.
If you're just joining the program, welcome. I'll get you up to speed on the scores briefly. On the S&P, we're negative here by 0.2%. We talked there about the consumer spending, the retailers. Let's breathe some life into that conversation. Buy now, pay later. What is more important to you? How much consumers spend or how they spend? This in the Journal this week, citing that data we've all been talking about from Adobe. The trend of consumers using buy now, pay later options reached a record high Cyber Monday, contributing $940 million US to Monday sales. That is a 43% surge from last year. They are big changes for buy now, pay later from last year to this year.
Two things. One of them is there's a cohort of people who don't want to partake in the credit card sphere, so they're increasingly going to buy now, pay later.
Or can't.
Right, and basically this is a way to not pay interest, but also not necessarily feel like you're committed in that kind of way. But second of all, this really raises a question of when the bills come due and whether people are stretching beyond their means by adding lots of smaller payments to their monthly load that all start to accumulate in a way that can become suffocating.
Can we buy trucks, cyber trucks, buy now, pay later?
You might have to wait until 2025.
For the cheaper option?
For the cheaper option, yeah. And you could buy a decal that shows the smashed window.
I saw that. How much is that?
$55.
I can afford that. I'll pay cash for that.
Yeah, but you're not going to put it on Tesla trucks because it's not coming until 2025.
I don't know about the truck. Let's have that conversation with Dan Ives of Wedbush. What an achievement to finally get some customer deliveries for this beast. Speaking of the cyber beast, we'll talk about that as well a little bit later. That's a model name, isn't it?
Yeah, it also looks like a beast.
That conversation up next from New York. This is Bloomberg.
times and global leadership are on Bloomberg.
What we've just delivered are significant tax cuts. For business, we will be the only major G7 economy, certainly, and even broader than that, where you get a total write-off against your taxes for capital investment. And it comes on top of the fact that our corporation tax rate here is lower than any other G7 economy. That's an incredibly generous regime to attract business investment.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything. Tuesday, a special episode of Bloomberg Surveillance live from Apollo's headquarters. Join Tom, John, and Lisa for exclusive interviews with top leaders in finance, including Apollo's Mark Rowan and Jim Zelter, about the state of private markets, recession risk in the new year, and deal-making amid high interest rates. It's all happening December 5th, starting at 6 a.m. Eastern on Bloomberg. Context changes everything.
We have a car here that experts said was impossible, that experts said would never be made. Tougher than bullets, tow pretty much anything, faster than a 911 while towing a 911. So, and deliveries begin now.
That's the pitch. Tesla CEO Elon Musk speaking at the Cybertruck delivery event in Austin 4 years after their announcement of the vehicle. And I have to eat some humble pie, because 4 years ago, when I first saw the design for this vehicle, Danos might remember this, I described it as an 8-year-old drawing the car of the future. Just these jagged lines, and it looked ridiculous. And here we are. The thing looks phenomenal, and everyone wants to buy one, at least the people I speak to.
You still think it looks like an 8-year-old drew it, so it's not like
I do, but what do I know about car design?
Well,
because apparently everyone thinks this is the car of the future, and they want to buy it.
Well, apparently Dan Ives thinks that you're a great candidate to get in one of those and drive off the lot.
We'll have that conversation right now. Yeah, Dan Ives is pitching the Cybertruck to me in a commercial break. Dan, it's good to see you.
Great to be here.
It's fantastic to catch up. This beast, deliveries. Talk to me about how transformational this might be for the company.
It's a historic moment. I mean, it's 4 years in the making, and I think the reason it's important in terms of this could be another growth vehicle for Musk and Tesla, and it also just shows what's happened. 313 area code, GM, Ford peeling back a little on EVs. Tesla is doubling down, and I think this is an important moment. And you go back over the years, many times been counted out, but yet they've come out in a flex the muscles moment.
I want to talk margins a little bit more with you, but just on the point you made, bringing up GM and Ford, are we finding out that people just want Teslas, they don't want EVs?
Look, I think it's a serious question here, because, you know, wanting an EV versus do you actually just want a Tesla? And I think you're starting to see now a moderation in terms of EV demand. Now, clearly, Tesla's had the price war that we've talked about in China. That's definitely, you know, left a bit of a stain. But I do think from a scale and scope perspective, you look at Fisker reducing guidance again today, no one could match the scale and scope of Musk and Tesla. And I think that lead continues to further be there. And I think that's what's happened, a little humble pie maybe with traditional automakers.
Well, John Lawler was on yesterday, CFO of Ford, and he was talking about how there was a different audience for the initial Teslas because it was the first adopters. And they were willing to pay a price premium, and they were willing to come in, and they were Tesla adopters. The ones who are coming in now are looking for price, value, quality, et cetera. It is a different pool, or that can be pulled away more aggressively. In that kind of environment, does Tesla's margin story start to get eroded?
I think, and John talked about it, I think that's, right now, that's the balancing act. Because if you look from a margin perspective, it's really been volume over margins. In the street, you know, so far, that's been the right strategy. Next 2-3 quarters, you need to see margins trough out, level out here. But when you look at Cybertruck, look, essentially, they'll be losing, let's say, $30,000, $40,000 per vehicle for the next year and a half. Then it starts to become profitable. But that is the near-term pain for long-term gain that they need to do in what continues to be this green tidal wave.
You know, to John's point, when he's saying people just want a Tesla, I wonder how much that's people wanting to ride Elon Musk's wave, and how much that was really the feeling a number of years ago, how much some of the recent high-profile discussion around Elon Musk with X, with his colorful interview and commentary toward advertisers, does that draw people in or push them away?
I think there's still a question there, because to some it emboldens them in terms of Musk, what he represents. He's the anti, that's, you know, I affiliate, you know, with the Tesla. But then on the other hand, you alienate. And the problem for, I think, Tesla investors, when you sell consumer products to the masses, you don't want controversy. But again, Musk is Musk, goes the beat of a different drum, and you see, and that's, you know, we saw that maybe overshadow a bit in terms of what happened at the New York Times event, the Cybertruck unveiling. That's 4 years in the making. But at the end of the day, Musk will continue to, I think, innovate, and especially when it comes to Cybertruck, a historical moment.
What did you think about what happened this week?
I think it's one where it's the last thing you want to see as a Tesla bull, to see something like that come and ultimately overshadow what was going to be Cybertruck. But as we all know, Musk is Musk. And it goes back to what we've talked about a lot on the show. When he bought Twitter, the $44 billion mistake, in my opinion, which now, let's say X is worth $5 to $8 billion, this is always the worry. It just adds that tornado factor. Because with Musk, if you give him a mic, you never know what's going to happen.
Sure.
And that's part of the problem here. And even though many could say, it's great, go get him. Okay, but there's a business there. It's been essentially taken out with debt. So eventually that you're going to have to pay someone in terms of what's happened with X.
I think you just put a Dan Ives multiple on X there with that valuation, but we'll come back to that another time. I want to talk about margins just a little bit more. There's a massive opportunity, if you didn't have this truck, to keep on pushing and squeezing Ford and GM. GM have come out with numbers this week, basically telling us that the labor market contract, the labor contract, would add an additional $575 per vehicle. At Ford, it's upwards of $900. Does this truck complicate their effort to really put the squeeze on Ford and GM in the way they have done over the last year?
I think it does a little, because ultimately, when you look at the UAW debacle and the 313 error code, it's put Farley, it's put back against the wall. And that adds to the cost. I think where they're going to squeeze them continues to really be on that 40 to 50K price points in terms of sedans. That's what they're going after. But that's also why Mary, and you've seen from Farley as well, they're kind of coming back a little from the edge, not maybe going full EV, where Tesla's actually going the opposite. And that's essentially what's happening right now. This is all a game of high-stakes poker. And I think everyone's trying to figure out what Musk's next move is in 2024.
And who it's catered to. I mean, that's another question, too, because the audiences of Ford and GM much more focused domestically, whereas Elon Musk has a big audience in China as well. How much is the Cybertruck geared toward American buyers, and how much is it geared toward international buyers?
Yeah, and Lisa, that's a great point, because look, China, the hearts and lungs of the Tesla growth story, it is in China, 45% of demand. And I think what really he's focused on here with Cybertruck, it's, first of all, it's showing from an innovation technology perspective just how far they are, but the opportunity, even though it's starting in the US, it is international. It's Europe, it's China, and I think that's really the global focus of Tesla. You look at Ford, there's many that have kind of customers fought against going toward an EV. I'm a traditional F-150, I'm not going to go there. Dealers have fought against it, and they've heard it loud and clear in Detroit.
Do you think it's attractive?
Look, the Mad Max vehicle, and I remember when you talked about that in 2019, I think we talked about that together. I believe, I get it, it's on the edge, but I think it's innovative, it's new, and it's something where Tesla is not going to go down the typical path of other automakers. And that's why, you know, like, look, when I see you driving this in New York about 6-9 months from now.
TK in the passenger seat.
TK in the passenger seat. It's with Cybertruck, it's going to be
Can you take the roof off? The roof come off?
But you could be in the back as well. So it's going to be super interesting.
Am I the only one who drives?
You are.
Yeah, just...
Bramo's got to drive. TK and I don't drive.
So I'll drive. They get in the back.
And again, but Lisa could be driving. You got TK, shotgun, Barrows in the back. Yeah,
sleeping.
That's not going to happen.
All right, looks good.
Sleeping.
Dan, thank you. Dan Ives at Wedbush. On a serious note, to Dan's point, and you went there, it's BYD, it's NIO. That's the real competition here.
100%.
Can Ford and GM really even get in the game? Can they actually get in the game?
Well, which game, right? And I think that that's really the key, because they can get in the game of offering a vehicle that people would have otherwise bought that was a fossil fuel burning vehicle that was electric, if they offer a similar kind of price point and economically works out to be less because there are the charging stations. It is a different audience than the people who go out and proactively seek out a Tesla.
This was great. Dan, it's good to see you.
Yeah, great to be here.
Always. Thank you, buddy. Thank you. In the next hour on Bloomberg TV, Jay Pulaski at TPW, Mike Schumacher of Wells Fargo, Savita Subramaniam of BofA, Savita Subramaniam on 5K on the S&P 500 next year. From New York, this is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We are 1 hour away from the opening day on the first day of the last month of 2023, which has felt like 4 years tied into one. Welcome back. This is Bloomberg Surveillance. John's off preparing for his 9 a.m. We are looking at a bit of a retracement, but it's hard to say that. Basically, people are just sleeping in after a blockbuster month where we saw the biggest returns going back to early last year for the S&P, for the NASDAQ, massive rally in the NASDAQ in particular, really led by bonds. And to me, the stat of the morning, we keep repeating it, but it's worth saying again, Bank of America pointing out the 60-40 portfolio had its best performance over the past month, going back to December of 1991. Fueling this, hopes of rate cuts. Do we get the data to potentially back that up? A slew of recent Fed speaks showing some divergence ahead of Chair Powell's speech at 11 a.m. President Bostic and Harker signaling that they think the central bank has done enough. President Barkin and Governor Bowman joining the majority of officials, leaving the door open for further hikes. I love that we have this in a chart. The fact that we are parsing through this, Michael McKee focuses our attention very much on how everyone else is just uncertain and looking for guides. Mike, what are we expecting to hear later this morning from Fed Chair Jay Powell?
Saw an interesting headline this morning describing the markets as hovering. I hadn't heard that term before. Hovering over Jay Powell. You're going to hear the same thing that you've heard from Jay Powell before, and that's why I put him on the list of people who think that they've done enough for the moment, but keeping their options open, because that's what he has said this month, even after the Fed decision on November 1st. He said that we're going to be cautious about not getting faked out by 1 month's data, but we are going to raise rates if we need to. And so I think you'll get more of that today if he wants to say anything at all. I assume he does because there's so much focus on it that if he didn't, maybe somebody would read something into that.
You know, I'm actually more interested in the ISM manufacturing data that comes out at 10 a.m., an hour before Fed Chair Jay Powell, because ultimately it's going to be about the data and the trajectory and sort of some of the benchmarks that people have. What do you make of the fact that manufacturing continues to be in recession, has been in recession for a full year or so, and that people are viewing that as an isolated sector that continues to be in a world of hurt, even as services continues to chug along?
Well, that is sort of the dichotomy of the economy at this point. People are buying services, they're not buying goods, so we have seen a decline in manufacturing. However, this could be an interesting ISM. We'll have to see how the numbers come out, particularly for orders and production, because remember we had the UAW strike, and that didn't get settled until October. So this November number for ISM is probably going to show a rebound from just the workers going back to work on the assembly line starting up again. So we'll have to shade that a little bit off. And it's going to be the same a week from today when we do the jobs report, because we'll have all those auto workers back on the payrolls.
Is data weakening? Do we see economic data weakening, or are we seeing ongoing strength with the fastest pace of GDP growth in quite a while in the third quarter, along with disinflation that people are just saying is enough weakness to sort of create nirvana?
Well, that depends on how you define weakness, I guess. Yes, the data show that things are weakening in the economy. Consumer spending is a little bit slower than it has been, and we're seeing hiring slow down. We've seen jobless benefits rise a little bit, but this is all a little bit. It's on the margins. The problem is you don't know if that leads to recession, and Bloomberg Economics still hanging under their recession call, based on the fact that all of a sudden you get a non-linear drop in confidence, and then everybody stops spending. What would cause that? I don't know. But it is a possibility. So we're seeing rates, the forecast for rates cuts in 2024 really pick up steam in recent days. There's two camps: the people who think that we're going to have this nirvana thing, inflation's going to come way down, and that'll bring real rates up. And then there are those who still think that there's a possibility of a recession because the economy is slowing. And historically, when it has done that, it hasn't stopped. It keeps going.
Michael McKee, stay close, please, as we parse through what we can expect heading into the weekend and into next week. I got this message from Drew Mattis over at MetLife, basically saying, we have not had a normal recession in more than 20 years. Most traders have never seen one. Maybe this is why people don't know what to make of the seemingly disinflationary nirvana, as some people are calling it. Lauren Goodwin joining us now, economist, director of portfolio strategy at New York Life Investments, director of disinflationary nirvana narratives. Do you buy it?
I don't buy it. I think we're sitting there right now, but that it's a stop on the train towards recession. And the reason for that, twofold really. One is the long and variable lags of monetary policy. We're sort of right on time for an average recession timeline from the first Fed rate hike. But the other is that if we did get a cut in March or May, and inflation wasn't falling precipitously, we weren't heading towards recession, then I think we'd see financial market conditions ease pretty significantly. And Chair Powell and other Fed members have been very insistent that they don't want to see that. That's a recipe for likely a reacceleration of activity and makes the inflationary environment more sticky.
So when we take a look at where you want to play the best returns for 60-40, going back to 1991, do you lean in or do you lean against it and say someone's got to be wrong here, whoever it is, I'm going to move against?
Well, as much as ink that we've spilt, I'm a part of it. As much words we've put out there about the soft versus hard landing debate, neither side has been the winner for investors all year, and I expect that to be the case for the first part of 2024 as well. What I mean by that is the only thing we're really certain about is that the market is facing uncertainty. And so landing strongly in one camp or the other isn't likely to be the answer. It's quality. And I think we're seeing that over the course of this year, investors leaning into profitability, to dividend yields, and to areas of the market where investors expect that no matter what happens in the first half of next year, they can build some resilience.
So when in doubt, buy Microsoft. Is that basically what you're saying? I mean, essentially, that's basically been the market narrative so far. Or they're not the market narrative. This is what people are saying. We don't know what's going to happen. We'll just buy big tech and sit and wait.
It's a part of the story. One of the things I think will shift over the course of 2024 specific to the tech narrative is that the excitement around productivity and the new technological developments we're getting from the artificial intelligence trend have been centered in the foundational layer of tech, not least because that's also where consumers spend money. As the consumer experiences the sort of dissonance of high price levels that you've covered so well, I expect that more of the story around tech will actually expand into the digital infrastructure and the application layer that get built on top of the foundational layer of tech.
Which really is sort of part of the difficulty understanding what's going on, because there are these sort of secular overlays like artificial intelligence, like weight loss drugs that are put over a lot of uncertainty and frankly a lot of underperformance of other rank and file companies. We saw, for example, over the past week, pretty big inflows into large cap U.S. stocks. We saw outflows yet again from the Russell 2000. What do you make of that? That basically small caps are going to be left for dead in a sense and continue to underperform dramatically, even with some sort of settling out in this narrative.
Small caps, as the economy slows, tend to underperform because they don't have the overhead, the administrative overhead that helps them to digest higher rates, higher costs, the way that large caps do. So it's not necessarily a matter of sector, but one of business model, one of truly size. I think there are a couple of exceptions. The tech sector is one of them, where profitability can exist in mid and small caps as well. But as we move through into Q1, I expect that the preference for, frankly, defensive allocation plays, large caps is one of them, defensive sectors, I really like infrastructure equity there. I think they're going to continue to gain ground because we're going to see more evidence that the data is slowing.
Isn't the best defense just cash?
There are benefits to cash when you're expecting a major fallout in the market, but one of the things that I think is so challenging about cash right now is that we see such strong opportunity to harvest yield in sectors of the economy that even if we see recession, which I expect, and even as spreads widen, you can still gain meaningful yield uptick in, for example, the high yield bond market.
Funny that you say that. High yield bonds had the biggest 4-week inflow going back to June 2020. This according to Bank of America, Michael's Hartnett. This to me highlights exactly what you're talking about. A lot of people are saying we don't have certainty about where things are going. We're going to pile into cash, $75 billion going in there in the past week. But we're also going to pile into income, because we know we're going to get something. Are you seeing sort of the reversal of the bond stock dynamic over the past 2 decades, where really bonds are your equity drivers in some ways, your income plays, and then you can sort of shoot for the moon on the peripheries with some equities?
Yes, that is what we're seeing. But I think what's specifically interesting about high yield is that we see investors, and we're doing the same, taking equity-like risk in high yield because you can harvest a meaningful coupon on these bonds while acknowledging that Fed programs early in the pandemic made the credit quality of this sector much more interesting relative to past economic cycles. So even if you expect spreads to widen, prices to fall as the economy stumbles, you can still make up for it with the income that you're able to capture from that sector.
So is that your highest conviction heading into next year? Can you give us a sense of kind of how you're framing at a time where there isn't a lot of conviction?
Yeah, so I want to be clear that even though we have a recessionary call in the first half of the year, I don't think that's particularly pessimistic. I think that's an optimistic scenario for the economy. It allows a reset. I also think that we're going to see risk assets continue to do well for the next couple of months. So what we're doing is taking advantage of this sugar rush while we have it to rebalance into themes that we think will work particularly well. We've talked about a few of them. Defensive sectors are really like infrastructure equity. We like high yield. And I do think that there's room to run in duration as well.
Do you think that the Cybertruck is attractive?
I will admit that I just saw it for the first time after hearing John say this morning it looks like a kindergartner drew it. Okay. And I could not disagree.
Okay, well, where have you been? Hiding under a rock? This thing has been out there. Lauren Goodwin, thank you so much for being with us. Wonderful to see you. Lauren Goodwin of New York Life Investments, thank you. And she, of course, will say, no, Lisa, you've been hiding under a rock because I haven't seen, what movie haven't I seen?
Die Hard.
Die Hard, which I guess is a bad thing. And that
it's a Christmas movie. I said it.
It's a Christmas
Why
movie.
is this a debate?
Everybody agrees it's a Christmas movie.
Okay, so I'll watch it for Christmas.
Look on this on social media and just put in Die Hard and you'll see this enormous debate goes on every year.
It's real. It's a real debate because check out social media. I will check out social media and I will watch the movie. Thank you for being with us, Lauren. If you are just joining the program, we do see a bit of a pause after a massive week, a massive year of gains, a massive month of gains. Year, month, it feels like the same thing. We've seen a gain of almost 11% for the NASDAQ going back to early last year, the biggest gain. We can see the S&P futures just off a touch now, down 0.2%, 45.68. Coming up, we're going to discuss another key aspect of technological advancement, which is weight loss drugs. We are going to be speaking with Madison Muller and Sam Fazeli on the latest issues in the weight loss industry. We were speaking about Pfizer and how the shares are lower there by 4.7% after they withdrew an early stage trial for a two-day pill, twice-a-day pill that could potentially compete with some of the other weight loss drugs. I just wonder, Michael McKee still with us here. I'm curious whether Fed officials are looking at some of these trends. I know that they're looking at AI. Do they look at the weight loss drugs and say, how is this going to transform productivity? How is this going to transform where people put their money?
Well, remarkably, all the Fed officials I know are in pretty good shape, so I don't think they're going to be buying it themselves.
They are, right? They all go hiking and
Yeah,
things?
they all go hiking. But in an abstract sense, you wonder about what the long-term issues might be until insurance companies pay for it. It's not going to be a big deal. But yeah, there could be some things down the road. I don't know how much it adds to productivity, but it might change some consumer spending patterns at some point.
I just wonder how they kind of discuss these things because it is something that at least the market is treating as a potential game changer. And it would potentially change economies. I don't know. I mean, health insurance, think about how big of a proportion of inflation health insurance is. What if that comes in? Is that disinflationary or deflationary? I mean, these are some of the things that they've got to think about.
Well, health insurance has been inflationary, and it'll be interesting. We're coming up on the renewal periods, so we'll see how much premiums go up in the next year and whether that adds to inflation. Usually does in the month of January. But I don't think we have to worry about the weight loss drugs yet because it's really hard to get insurance for those.
Well, we shall see whether that changes, because I know that's a big debate, and there's some bipartisan support on that. Michael McKee, thank you so much for being with us. Coming up, we will delve into that conversation. Right now, we can see a bit of a pause. Yields, massive, massive month. We can see now 4.33%, rounded up.
The reception, the acceptance of Porosangue has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Porosangue all over the world.
How much do you worry about increasing production and therefore becoming I guess, less high-end luxury.
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open. Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
We are waiting to see the results. It's all about data. Data will speak. If the data are good, we are going to move into phase 3. We thought that the market would be 90 billion altogether, of which 1/3, 30, will be the orals. Right now, the market looks like it will be even bigger. So, yes, it is a sizable opportunity if you have an oral anti-obesity drug.
That was Peter Bourla, Pfizer CEO, speaking to Bloomberg back in October on their weight loss drug, talking about the oral application rather than the injectable. The data has spoken, and Pfizer falling this morning after stopping development of its experimental weight loss pill after side effects forced more than half the patients taking part in a study to stop taking the drug. Pfizer has fallen significantly this year as the pandemic fades, even as you see the others, the competitor drug companies, weight loss drugs made by Eli Lilly and Novo Nordisk, spurring massive gains. Joining me now, I'm so pleased to say, Sam Fazeli, senior pharmaceutical analyst at Bloomberg Intelligence, as well as Madison Muller of Bloomberg News. Madison, I want to start with you. There's a real question here about how significant of a setback this really has been for Pfizer.
Yeah, well, Pfizer has really been pinning its hopes on this weight loss pill. Other drug makers are clearly trying to get in on this market. It's become so big. It's the hottest thing in pharma, as we keep seeing. And one of the ways that Pfizer and AstraZeneca see an inroad into this market is with weight loss pills. They're sort of banking on the fact that people will prefer pills over injectables. And Pfizer's really struggled this year as the pandemic fades. And so a lot of its hopes were being sort of pinned on these weight loss pills. And this is definitely a setback for them right now.
Sam, you know, I have to say, when I heard about the side effects, it sounds similar, but maybe more extreme than some of the side effects for the injectables. How closely are these things being examined, not only for the short-term side effects, but the longer-term side effects?
Yeah, you know, the longer-term side effects will, by definition, take time to come through, although these drugs or these mechanisms of action have actually been used in diabetes patients for over a decade now, starting in around the early 2010s. The shorter-term side effects, which is mostly gastrointestinal, nausea, vomiting in some people, discomfort, those are common across the drugs. In the case of Pfizer, this data suggests that it seems to be a lot higher than we would have that we saw with the current drugs, Wegovy and Zepbound, which is just recently launched. The issue I think here is, although, is that first it's an oral drug, so you're delivering it to the gastrointestinal tract, and secondly, because it's twice a day, it's possible that you're getting peaks of drug release that are causing that. So maybe their once-a-day drug will deal with this problem.
How much daylight, Sam, is there between the different drugs that generally target the same thing?
Yeah, based on the data that we have today, Eli Lilly's Zepbound, it seems to be the most effective drug. And now, none of these have really been compared head-to-head. So you really need to go into a randomized head-to-head comparison, and the companies are doing that. So they're confident of the profile of the drug, and they're doing that comparison. It does look like Eli Lilly's drug is the more effective one. That's Zepbound, followed by Wegovy, and pretty much everybody else comes up with about the same sort of weight loss that you see with Wegovy at the best, and then potentially a bit lower.
Madison, how much is Pfizer kind of late to the game, in part because they were distracted by the pandemic and they were so focused on really developing the vaccine, rolling it out, and being in the spotlight for that?
Yeah, I mean, they are a little bit late. Novo Nordisk and Eli Lilly clearly have the lead in this market. They also have the lead in developing pills. Novo Nordisk already has a pill version of Ozempic. It's called Rybelsus. They're developing a higher dose version of that. That's going to be essentially a pill version of Wegovy, their weight loss drug. Could be available as soon as next year. Lilly's weight loss pill, or Orforglipron, looks really good. It's, advancing ahead. And so this data and the fact that Pfizer is discontinuing this trial sort of puts them back even further. But it's important for other drug makers to enter this space because eventually it will hopefully help bring down costs and everything in the market.
The other thing that would bring down costs is if insurance has to pay, and there is some sort of collective negotiating from that front. How much is that in the discussion, especially with some of the benefits that are associated with losing weight in certain patients?
Yeah, so I mean, that's why these drug makers are doing a lot of studies right now looking at other indications. So we've seen this with heart disease. They're studying knee osteoarthritis, sleep apnea, all of these other indications, because we know that cardiometabolic conditions are very interrelated, and they have, obesity is linked to like 200 other conditions. And so these studies are a really important piece of that in convincing insurers that these drugs are worth covering. But so far, the landscape is still pretty spotty there.
Sam, I'm curious your perspective, because you've been covering and in the pharmaceutical industry for a very long time. Do you think that that is a big part of the game plan? That yes, that these drugs have to be taken long term in order to remain effective, and that ultimately insurance companies will be prompted to pay for them?
Yeah, I mean, the problem is often solved in the single-payer markets, because the same people who pay for the drugs are the same people who pay for your hospitalization costs, etc. So that's the critical element here, in that what the U.S. system needs to do is to look at the longer-term benefit of these drugs. The cardiovascular benefits that you were just talking about, the potential effect on blood pressure and even Alzheimer's. I mean, time will tell. They're being tested in Alzheimer's. It is possible, as Madison said, that these drugs that obesity is related to 200 other diseases. If you manage that, you overall reduce the burden on the healthcare system. So I think insurance companies will eventually have to pay for it, but they're going to try and get these prices down as much as possible. And frankly, we have to say that we think that the rebates on the list prices that you see for these drugs is already at around the 50% mark. So, and that's just going to get deeper as we go forward.
Is it true, Sam, that you have to keep taking it, or else all the weight and then some will come back?
I mean, let me put it this way. Just take it the other way. If you diet, which also is basically the same idea of eating less, which is what Wegovy does to you, reduces your appetite. If you diet, you lose weight. If you stop dieting, your weight goes back up again. So it's the same principle. You're not resetting, unfortunately, the underlying, whatever the reason is, driver of your increased appetite in obesity. Now, maybe over the long term, if you use these drugs for a year, 2 or 3 years, you might be resetting that desire level. I don't know how the biology of that would be, but that would have to be shown.
Madison, how much are people using this for medical reasons, and how much for cosmetics?
That is something that still sort of remains to be seen. I mean, there is a ton of off-label usage happening, and that's being driven by, hype in Hollywood and social media. And we know that people are, who might not necessarily have diabetes or obesity are taking these drugs, are seeking out even knockoff versions that are not approved by regulators in the US and outside of the US because the demand is so high. But these drugs are really, really life-changing for people with diabetes and obesity who need them. And it's important that those people have access to the drugs. And, that's something that's still sort of a challenge.
How much of the pharmaceutical money is sort of shifted toward weight loss?
I mean, that is where it's going. I mean, that's the market that is expected to grow to be, you know, potentially $100 billion by 2030 is that obesity market, just that. And so that is really what the drug makers are looking at, and some of the drug makers that are still looking at getting into this market are targeting the weight loss side of it.
Sam, from a scientific standpoint, I'm curious what your biggest concern is, because some people would say it sounds too good to be true. It's something that people have always been looking for, is a pill or something, rather than go to the gym, that makes them shed all the weight. What is your concern longer term about some of these pharmaceuticals?
I mean, as I said, the Novo Nordisk and Eli Lilly have been using these drugs, these mechanisms, for treatment of diabetes for several years and over a decade now with regards to Novo Nordisk. So we know, at least at certain doses, in the diabetic population, what their risk profile is like. And nothing has really come out of the blue to surprise anybody. Maybe over the long term, when hundreds of millions of people use this, which would be a phenomenal boom for the pharma sector, some very low levels of side effects come out. At the end of the day, you are introducing a therapeutic, a drug into the system. Just doing weight loss by using diet and exercise, that obviously is the ideal way. But we clearly see that that's not sufficient. So I'm not really worried about side effects, given what we already know. You never know what's going to happen. With the one drug I do worry about a little bit is the high dose that Wegovy uses, which is Novo Nordisk's. And that's higher, that's been used on average in diabetics. But as time passes, and that also shows no major safety concerns, I don't lose sleep over it.
Bloomberg, Sam Fazeli, Madison Muller, both of you, thank you so much on an issue that we will be talking more about inevitably over the weeks, months, and years to come. Right now, in markets, basically going nowhere after nearly 11% gain on the NASDAQ, more than 9% gain on the S&P. Coming up on Bloomberg Wall Street Week tonight at 6 p.m., Catherine Keating of BNY Mellon Wealth Management, former U.S. Treasury Secretary Larry Summers, and Jean-Yves Fillon of BNP Paribas. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we can deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but it's painful for us to see the toll dementia has taken on her. So this is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California in San Francisco, dementia, and this is a promising area.
Maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
This is Bloomberg.
Let's get you to the weekend. Live from New York City this morning. Good morning, good morning. Your equity market on the S&P 500 pulling back just a touch on the S&P. We're down 0.2%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
From New York, coming up, it was a November to remember for the equity bulls, with rate cut hopes fueling a monster everything rally. Chair Powell getting his say before the Fed goes quiet. We begin with the big issue. Chair Powell up next.
Chair Powell, Jerome Powell, he sits down for that fireside chat.
Chair Powell's going to hedge a little bit and say, we're not talking about cuts here.
The debate right now is when are they going to ease?
How many months is it before they contemplate lowering rates?
The bar for the Fed to cut rates is high.
The hurdle is still high here with inflation in the 3.5–4% range.
We need that inflation convincingly closer to 2%.
Unemployment rate needs to start moving materially higher.
The Fed starts to change its tune once you see a sub 100K payroll print.
There's an element of we don't want the market to get too ahead of itself.
Powell is trying and failing to teach the market, a little bit of patience.
Markets are hearing what they want to hear.
The Fed has a very high incentive to continue to keep another rate hike on the table.
They don't want to extract, a loss from the jaws of victory.
They're going to be happy to just buy time, wait for data.
The Fed doesn't know what they're going to do next.
Joining us now to discuss TPW's Jay Pawlowski, Mike Schumacher, Wells Fargo. Gents, let's get straight into it. Jay, any reason for Chairman Powell to push back today?
No, look, John, we think the Fed is increasingly in the rearview mirror, less and less important. We're switching globally from a monetary policy-led regime to a fiscal policy-led regime, and we expect the Fed to become a frenemy of markets. So not an enemy anymore. Rate hikes are done, but not fully a friend because we're not really sure where the Fed stands. But in our view, the next moves for the Fed are going to be rate cuts, and not because we're going into recession, but because inflation has fallen fast enough and far enough such that it gives them room to cut and provide insurance policy for risk assets.
Mike Schumacher, do you agree?
Actually, no. As far as the Fed today, John, I'll take the other side. We think Powell pushes back, and the reason is financial conditions have eased far too quickly. You mentioned at the outset in November to remember, that's right, stocks rocking, bonds ripping. These are not great things for the Fed. So the challenge for Jay Powell today is to say we're going to keep rates high, not maybe higher, but high for quite some time. So he'll push back a bit, I think.
Jay, why isn't this a premature easing of financial conditions?
Because inflation is falling, John. Look, we put out our 2024 outlook over a month ago now, and one of our 4 macro surprises was lower than expected inflation sooner than expected. And we got the October number to set us off on this November to remember. We got PCE yesterday running at an annualized rate of exactly 2%. We had European inflation year over year of 2.4%. This is a global issue. Supply chain pressures, which is a big factor for the inflation we saw over the last year and a half or so, have eased completely. Record low supply chain pressures, according to the New York Fed. And so the Fed does not need to do anything. So sure, today, maybe he pushes back a little bit. That's meaningless to me. I'm not looking at the day-to-day trading. I'm looking at the next 6 to 12 months. And what I see over the next 6 to 12 months is a return to macro stability, in part because of that lower than expected inflation sooner than expected. And that sets up a great environment for risk assets, particularly outside the United States.
It's 4 minutes into the show. We're all friends. I don't want you to fight, but Mike Schumacher, why is Jay wrong?
I think as far as the outlook for rate cuts happening, that's probably right. but it's a question of how quickly. And markets, since we all tend to have ADD in this business, are looking for the next rate cut. Take your pick, by the Fed, the ECB, whomever, to be pretty quick. And that's unlikely. So that's why I think when you look at market pricing, for instance, with the Fed being priced to ease, 45 basis points, give or take, by the middle of next year, a lot of that probably gets pushed back into the second half of the year. So the way we look at it is rates stay high for a while and then come down starting toward the middle of the year. So I think patience is the word yet. It's not really going to be a quick move down from here in yields. Yields have already fallen a lot. So I think people who are looking at another 50 to 75 basis point move lower in bond yields over the next few months are likely to be disappointed. The Fed and other central banks want to try and avoid that.
I want to get to the professional in the building, and it's not me, it's Mike McKee. Mike McKee has to follow Fed speak for us. Mike McKee, anything different from Chairman Powell later than what we got from Governor Waller earlier this week?
I don't think so. I'd like to throw him in the middle of this discussion here because I like seeing these guys fight. I mean, it makes life much more interesting on a Friday. Here's what we're seeing out there, and this is why it's become such a topic. What is Jay going to say today? The rate cut frenzy is really building in the markets. You can see in the last couple days how much people have priced in the idea of the first rate cut in May, and then in June, look where we are, 2 rate cuts in a row there. We get to 5 by January of 2025. At least that's what the markets are thinking today. And they've been encouraged, of course, by members of the Fed who have basically given us the message that they're done. Some have said, yes, absolutely, we're done. You can see that Bostic and Harker have said that. But as the sorting out puts them into different categories, really everybody's not that far apart. Now, you can see I've got Jay Powell in the maybe but category, and I'm going to give you the two-handed economist answer to your question, John, about what Powell's going to do. He's going to have it both ways because he wants to keep the idea of rate increases on the table, but not encourage people to price in too much more. So he'll say what he said earlier this month. This is after the Fed meeting. If it becomes appropriate to tighten policy further, we will not hesitate to do that. But we will continue to move carefully, however, allowing us to address both the risk of being misled by a few good months of data and the risk of over-tightening. So if there's a pushback, I think you get the pushback that you've already had, basically saying we're keeping our options open, even if you want to go ahead and think that we're not.
Mike McKee, thank you, sir. Let's spin the wheel and pick a Fed speaker. Let's go with President Bostic. Here's the quote. Our research and input from business leaders tell me the downward trajectory of inflation will likely continue. Jay, to his point, how much disinflation do you think is in the pipeline already that we're going to see in the months to come?
Yeah, John, great question. And for us, we're very focused on rents. Rents is a big factor, the shelter price, et cetera, in the CPI. It's been a big laggard. It's currently running at about 6 or 7% year over year. And we look at multifamily building, which is off the charts. Some great work done by folks on the street about this. And so over the next 6 to 12 months, we expect to see rents continue to come down. And that means that inflation is going to continue to come down. And that means the Fed can ease. Look, we're not focused on when the Fed cuts. We're focused on why the Fed cuts. And the Fed is going to cut because it can, because inflation is going to surprise to the downside rather than to protect against a recession. There's not going to be a recession. Everybody likes to talk about it, been talking about it for 18 months, hasn't happened. Some people still talk about it. We're not one of them, thankfully, and that's been the right call.
We still talk about it every day, Jay, as I'm sure you know from tuning in. Jay, that's your call on the Fed, on the economy. Now we need to talk about what's priced. Have we already priced that reality? JP Morgan really pushing back, saying this market is priced for a near perfect soft landing. What would you say back to that?
Well, I think the soft landing thesis is becoming proven, as I said. To us, we like to zoom out a little bit. So if you zoom out 2 years, the S&P yesterday closed at exactly the same level, exactly to the point where it was 2 years ago. So for 2 years, we've been digesting COVID, inflation, Fed hikes, etc. Now that's all finished. We're moving into a different regime. That regime is stability, and that allows us to think about higher prices for risk assets. The U.S. is somewhat priced for perfection. The upside is not as big in the U.S. equity market as it is elsewhere. A year ago, we were bullish on Europe. You and I talk about European banks all the time. 2023, bullish on Japan. Worked out great. 2024, we're the most positive on emerging market assets, debt and equity that we have been in years. That's where the opportunity lies.
It's Goldilocks, so let's talk about the bears. Mike Schumacher, you say there's 5 of them. Who are the bears?
When you think about the bears, John, really, number one is that the inflation environment really is not as cooperative as people think. So inflation, that last mile, is pretty sticky. Sarah House does a lot of great work here at Wells Fargo on that. She certainly would take the lead there. Certainly think that's in play. When you consider other issues out there, China's got a lot of disruption potential. I think that's a risk. In fact, one of the risks we considered, thinking about the macro outlook more broadly, is what if China actually surprises to the upside? So you think about the combination of inflation not really cooperating as quickly as people like. I agree with Jay, it comes down, but as it gets stuck, I think that's the big risk out there. And for me, that's the biggest bear. That's the grizzly bear.
Might have found something you agree on. Jay Pawlowski, China, and the prospect of an upturn through next year. What's the call?
Well, John, the way I've been thinking about it is that the Chinese firecracker has a very long fuse. And it's taking a while to hit and to explode. We've been constructive, as you know. We've talked about it on the show. Hasn't really happened yet. Been frustrating, disappointing. But our point is that China is continuing to act on the policy front, and that policy is going to gain traction. And as it gains traction, equities are going to perform better. China, on a valuation basis, is at a historic low versus the U.S. On a performance basis, at a historic low versus the U.S. Foreigners have been record sellers for the last 4 months. We remain constructive. But look, EM is not just China. We're very bullish on Poland. We're very bullish on Mexico. We're bullish on the countries that are benefiting from the regionalization of supply chains. And those two are two of the most attractive markets in the world, in our view.
Jay, sit tight. Jay Pawlowski, Mike Schumacher, sticking with us. About 20 minutes out from the opening bell. Equity futures shaping up as follows, pulling back by about 0.2%. With some movers, here's Abby.
Let's take a look at a few of the stocks that are dragging on futures this morning, John. Starting off with the shares of Tesla. Tesla is, the stock is heading to a third down day in a row. The Cybertruck launch event yesterday, of course, was a big deal, but investors not liking it so much, not giving us the stock a pop, perhaps because the lowest price Cybertruck is about $61,000 more than expected. Dell also lower, down 4.9%, missing revenue by 3.2%. Plus, the fourth quarter revenue guide has proven disappointing. Some analysts expecting PC demand to recover, though, in 2024. But right now, that's really not where the focus is. And then finally, take a look at Coinbase. It is popping higher with Bitcoin up about 1.4%. And if you can believe it, Coinbase, the stock, has tripled in 2023 with the company not just surviving the crypto chaos, but really, I would say, thriving.
Abby, thank you. More from Abigail around the opening bell. Coming up, a November to remember.
We're heading into the end of the year. If the economic data remains okay, which we think right now it is okay, we're in a soft landing right now. I think, you know, the market can continue to be in this FOMO world.
From stocks to bonds, global markets posting a monumental month of gains. That conversation up next.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
you also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Everything rally remains challenged. This FOMO rally, in a way, can continue into year-end. But I think as we think about next year, we should be mindful of those two risks. Does inflation come back down enough to 2% or below to allow the Fed to cut? And does the economy hold up?
It was a November to remember for the equity bulls. The S&P 500 advancing almost 9%. Its second best November since 1980. The Nasdaq 100 up double digits. That surge, part of a broader markets rally triggered by a plunge in bond yields on hopes the Fed is taming inflation without breaking the economy. But some sounding the alarm on the so-called everything rally. Mohammed Al-Arian of Bloomberg Opinion saying this morning: investors and analysts risk underestimating the challenges ahead during this period of understandable market euphoria. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, what really sticks out to me about the past month is that it wasn't just your giant tech companies that were really powering those gains. You saw a broadening out of the rally, especially if you look at the sector level. You had 10 of 11 S&P 500 sectors rally last month. Energy was your lone loser. And as you can see on the chart, the previous 3 months, only one sector had managed to post gains, and all 3 of those months had been losses at the index level. So decent breadth to go along with that size and scope. And as you mentioned, that bullishness was really born in the bond market. Yields finally cooling off after soaring to decade-plus highs as conviction really solidified that this Fed is truly done hiking. Now, that twin rally in stocks and bonds, it produced a banner month for 60-40 portfolios as well, rising about 7.3% in November, John. That is the best monthly performance since 2015. And again, it follows 3 straight months of losses. So in everything rally, certainly the right description for this market. And to Al-Arian's point, there are certainly reasons for pause here, but there is haven demand. It's not straight up euphoria. You take a look at gold trading near a record high. You take a look at money market funds at $5.8 trillion. Definitely some safety searching behavior going on, but still a huge big rally in November.
What a run in bonds and stocks. Katie, thank you. Let's turn to the bond market and sit there for a moment. 2-year, 10-year, 30-year. The move we've seen over the last month. We're talking about a 40 basis point move over 1 month. A 60 basis point move through November. Absolutely ridiculous, Mike Schumacher. And yet still, even with those massive gains, this is your view, that year-end, we're 4% on a 10-year. And not year-end this year, year-end next year. Mike Schumacher, help us understand that, why the limits of this rally takes yields down to just 4%.
No, we actually think the yields go lower than that, John. So we've got yields going to 4% actually at the end of the first quarter. So we're still pretty bullish, not as bullish as we had been because the speed has been spectacular. And I think toward the end of next year, you'll get a bit more of a rally as the Fed eventually comes into ease. But really the huge move, the turbocharged move, it's already happened. And the reason it kicked in my opinion, and Wells Fargo colleagues would certainly share this view, is supply fears really were mitigated back on November 1st by the Treasury's announcement that refunding would be not nearly as aggressive as it had been in August. So people said, oh, they're not going to bury us with bonds. We can actually buy some. That's good. Inflation data came out. We're pretty accommodating. That's been friendly as well. And real yields are super high. So we think real yields come down a lot more. Just to give some context on that, something like 180 on the 10-year by the end of the first quarter, down from 210, 215 today. So we do think the move continues through Q1, and then it moderates a bit from there even, John. So we're still bullish throughout the year, but I wouldn't say the speed limit's 4%.
Jay, what do you think the speed limit is?
John, we're not really super attracted by treasuries. As you know, we've been completely out of the treasury market for the last 3 years. We did dip a toe back in last month in our model portfolios, particularly at the short end, where we think as inflation comes in, the Fed able to cut, that's where there's opportunity. 10-year at 4.3%, broken an important technical level at about 4.35, suggesting that the rate hike risk is over. So that's good, but really don't see a huge amount of upside there. It's more of a coupon clipping exercise going forward than it is a capital appreciation opportunity. And so we continue to like credit, which is where we've been exposed within our fixed income sleeve. So U.S. high yield, emerging market debt, as I said, really love EM here. So EM local currency debt outperforming ag year to date by 500 basis points, as well as high yield in emerging markets. So that's where we really see the opportunity. And then when we think about rates going forward, look, our formula is simple. Lower inflation leads to lower rates, leads to a weaker dollar, which leads to better opportunities outside the U.S. And then the point about the money market funds, when we get to the macro stability where we're moving to, in our view, that unlocks the opportunity for that money market fund money to come back into risk assets. Money markets have taken in about 1.5 trillion year to date. There's a lot of money that, as good news stacks on good news, that money is going to continue to come into risk assets and support risk assets, particularly in our view, again, outside the United States.
You went exactly to where I want to go. Mike Schumacher, I want to talk about that money in money market funds, how sticky it is and what it would take to unlock it. Mike, what would it take to unlock that money that's piled up in money market funds?
Probably some gets unlocked pretty soon, John, as people look at both equities and long-term yields, look at this monster move in November, and they say, hey, I'm sitting in a money market, I'm getting 5% plus. That's nice for a year, but wow, if equities can do 9 or 10% in a month and bonds can have a terrific month as well, the opportunity cost is high. So the comfort level with moving out of money markets, out of T-bills, out of short-term super safe stuff into more risky assets, I think it's probably increasing as we speak. So there will be a lag. The retail investor is not going to really lead that process, but in our view, it starts to happen pretty quickly. So it's more comfort, a bit of performance chasing probably, but really the idea that you're not going to get blown out by yields going up in bond land by 100 basis points or the S&P falling 20%.
Mike, any idea where that money gets recycled, where it ends up? Does it get spread equally between risk assets and fixed income? Does it go further out along the curve? How are you thinking about that?
Yeah, we think more of it goes into equities and, quote, risky assets, John. So we've been thinking about really the incremental buyers of U.S. Treasuries next year. We've got retail investors buying a decent chunk, but a lot of that $500 billion we expect from retail is going to come from other sources. We've only got penciled in 100 to 100 and maybe 50 billion on the money market. So most of the money market flow, we think, probably finds a home elsewhere.
Interesting. Mike, always great to catch up. Thanks for the clarity around the fixed income call next year. Mike Schumacher there and Jay Pawlowski, very, very constructive going into next year. We are about 8 minutes away from the opening bell. Here's the setup right now for you this morning, this Friday morning, going into the weekend. Futures pulling back 0.2% on the S&P, taking a bit of a breather here in the opposite direction to the way we moved through November. Yields up a couple of basis points on a 2-year, reclaiming 470. The 10-year high by a single basis point, back through 430 after having a little look at the 420s, 434 on a US 10-year this morning. Coming up, the morning calls and later, the path to record highs. Bank of America's Savita Subramanian making the case for 5,000 on the S&P 500. That conversation about 7 minutes away.
The acceptance of Purosangue has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of puro sangue all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Anyone long the equity market was totally spoiled in the month of November. To start December, we pulled back by 0.25% on the S&P 500. We've talked a lot about the last month. Actually, after the close yesterday, on course for a 5th week of gains on the S&P, equaling the longest weekly run going back to June. That's the price action right now in the equity market. Let's get you some morning calls. Your first one from Morgan Stanley, downgrading Alibaba to equal weight, seeing a slower than expected turnaround and uncertainty surrounding its spin-off plans. That stock is down 1.9%. Your second call from Citi, downgrading Spotify to neutral, saying the risk reward is no longer compelling. The stock is negative by 2.1% in early trading. And your third and final call from the team over at UBS, upgrading Johnson & Johnson to a buy, growing increasingly bullish ahead of its analyst day next week. J&J up in a pre-market by a little more than 1%. Coming up on this program, some big calls for next year, including this one. Bank of America's Savita Subramaniam expecting stocks to hit fresh record highs next year. The price target at B of A, 5K. That conversation is coming up next. Your opening bow with futures slightly negative to kick off December is just around the corner.
This will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg UK, your source for for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
Slice through the noise. Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
Leaving behind the biggest monthly gain of the year so far on the S&P 500. Let's get December started for you. About 20 seconds away from the opening bell this morning. Good morning. Equities pulling back by 0.2% on the S&P 500. On the Nasdaq 100, what a stellar run over the previous month. We're negative here by 0.3%. There's your opening bell. Switch up the board and get to the bond market. Yields look like this on a 10-year, higher by a single basis point, 4.3417. That's the session. November down 60 basis points on a 10-year yield. In the FX market, best month of the year for the euro against the dollar, but we pulled back 108.64. We're negative 0.2% on that currency pair. Jeff Yu, BNY Mellon, with quite a call for next year. Him and the team are looking for parity all over again on the euro. He says the ECB is going to cut first. That's the FX market. Let's turn to crude. $76 a barrel on WTI. Let's call it $75.99 to 76. We're just about unchanged on the session. 30 seconds into this session, we are negative 0.2% on the S&P 500. On the Nasdaq, we're down by 0.3. The early mover for you, it's Dow, the company reporting weaker than expected revenue. Abby on top of this one. Hey, Abby.
Hey, John. Investors really not liking this. Right now, the stock is down more than 5%. The worst day in almost a year, and it does have to do with the revenue miss and the revenue guide. Now, relative to the quarter that was, revenue fell short of estimates by just a little bit. They put up $22.3 billion worth of revenue. The average estimate was $23 billion, and it represents a 10% fall. The quarter ahead, they are talking about revenue of about $22 billion. The street was closer to $24 billion. Now, before we feel too bad for Dell, the stock on the year is up more than 88% coming into today. That has to do with the key phrase, catchphrase, AI, because they have a server business that powers AI, and that is still strong, but it seems as though the legacy business still matters, John. The stock, again, down 5.7%, the worst day in a year.
71.49. Abby, thanks for that. Let's turn to Big Pharma and get to a big move for Pfizer, axing development of its weight loss pill due to big side effects. Simone Foxman has this one. Hey, Simone.
Hey, John, yeah, shares down now close to 5.8%. Pfizer had been really pinning its hopes on this oral weight loss pill. And this was a study of people taking this twice daily. Now, these are mild side effects in medical terms, but they are pretty substantial. And when you look at the numbers, nausea, up to 73% of patients experience that, vomiting up to 47%, and diarrhea up to 25%. So the company is going to stop studying this pill for twice daily while it will continue studying it on a once daily basis. You know, all of these GLP-1 makers, these weight loss and diabetes pills, have really struggled to find a weight loss indication that is able to be taken orally. And this is the real opening in the market at this moment, because if you look, 44% of Americans say they'd be interested in taking one of these GLP-1s, but that number drops to about 23% when they learn they have to take it on an injection basis. Bloomberg Intelligence says this leaves Pfizer's overall obesity drug hopes in limbo, but Bank of America also said in a note today that, you know, hopes weren't particularly high for Pfizer in obesity in general, but we are looking at shares down 5.8% in a reaction to this move. Just more challenges for Pfizer as they shift away from COVID, the COVID era.
Simone, thank you. I think sometimes you don't really want the details of those stories, do you? That stock is up in early trading. Eli Lilly moving in the other direction. Music to the ears, I'm sure, of them. And I'm sure of Novo Nordisk as well. Let's turn to Tesla. After a 2-year delay, the company delivering Cybertrucks to customers. Ed Ludlow has this one. Morning, Ed.
Yeah, good morning, Jonathan. Tesla is down 3% as it stands. The story that the pricing of the Cybertruck higher than initially marketed in 2019. We knew that would change because A, we've had a pandemic since, and the supply chain has broken down, but it is higher than what the street was expecting. 3 variants of the Cybertruck. The cheapest one, a rear-wheel drive, $60,990 before any incentives or savings, but it's not going to be available until 2025. 250 miles of range. All-wheel drive, just shy of $80,000 available next year, 340 miles of range. And then the one for you, John, the Cyber Beast, $99,990 US before savings, 320 miles of range, but it can be added to the range with a range extender available this year. I think the street is basically saying we don't know how this is going to go. There are 1 million reservations, and on one hand, some people say demand is so great that the 1 million of reservations is great. It's going to be a big product for Tesla. Others are going to saying Tesla's going to control the output of it, make it a niche product, make it scarce, but they're also questioning the conversion rate. Just because there are 1 million people who've put a $100 deposit down, it doesn't mean they're going to go through with buying it, particularly in light of how expensive it is.
I can just about afford that smashed window decal that apparently is selling out online. I want to get to this headline with you. Translate this for our audience. The US sets stringent limits on Chinese content for EV tax credits.
Yes.
Ed, what's going on?
Critically important. The threshold for a foreign entity of concern in the battery supply chain is 25% as it relates to China ownership. That means any company that has a hand in the battery supply chain, be it the assembly or the components themselves, if that threshold is above 25% and they've played a role in the assembly of a battery pack, that vehicle will not be eligible for the $7,500 tax credit. These are severe and stringent limits that the Biden administration has put in place, and it now puts into question a lot of the market that's out there. And I think you'll see a pretty quick scramble, and I've reported a lot of this, right, John? There is a scramble to onshore so much of that supply chain starting now, 2024.
But just to go one further, Ed, where does it leave BYD and NIO forever coming to these shores and competing successfully?
It means if they don't have a long-term plan, they need one already. But you know, Ford and Tesla are all in the same boat, right? Because a lot of those that are investing in this country, and indeed North America as a whole, Canada and Mexico, are Chinese firms or ties to Chinese firms. Think, for example, CATL, and as I've recently reported, AESC. This is a pretty universal problem. But again, does it shut the door to a Chinese manufacturer coming here with a car? It's a big question.
Well, the wall gets higher, that's for sure. Ed, thank you, buddy. Thanks for the catch-up. Ed Ludlow there. Let's stick on China. Alibaba getting hit with a rare downgrade from Morgan Stanley. Katie Grofeld has this. Hey, Katie.
Hey, John. Yeah, Morgan Stanley knocking Alibaba's ADRs down to equal weight from overweight, also lowering the price target to $90 from $110. Now, the logic there is that Alibaba's turnaround is proceeding more slowly than expected, and its decision to withdraw the spinoff of its cloud business, quote, brings uncertainty to the value unlocking from reorganization. Now, adding insult to injury here, in addition to downgrading Alibaba, Morgan Stanley also named rival PDD Holdings, of course, the parent company of Pinduoduo, as its top pick in China's e-commerce sector. That helped PDD overtake Alibaba in market cap for the first time ever. Now, Morgan Stanley's downgrade is Alibaba's first since about late June, and it comes amid a pretty disappointing year for the company. All told, so far in 2023, Alibaba shares lower by about 15%, John.
Katie, thank you. We're down about 3% this morning. Just to get to the broader price action, 7 minutes in, we're down by 0.2% on the S&P. We're down by almost 0.5% on the NASDAQ to kick off December after a massive month of November. Here's the outlook from Bank of America and Savita Subramaniam, expecting stocks to hit a record high next year, writing this: we're past maximum macro uncertainty. With markets absorbing significant geopolitical shocks already, we're bullish not because we expect the Fed to cut, but because of what the Fed has accomplished. Her S&P 500 price target of 5K, among the most bullish on Wall Street. Savita, I'm pleased to say, joins us right now. Savita, you say it's the year of the landing. Talk to me about what that landing looks like.
Yeah, so I think that here's the thing. Bull markets end in euphoria, and we are far
from euphoria today. If you look at allocations to equities over bonds, bond allocations are close to 30-year highs. In pension funds, equities are relatively lightly owned, with the exception of course, the Magnificent Seven. So our view is that we see a broader equity market rally next year. We see returns essentially move beyond just AI and tech to all of the potential beneficiaries of AI, tech, productivity, efficiency gains that we've seen companies focused on this year. I mean, I think the idea is that we've seen corporates and consumers defy expectations that this quick rate hike cycle would basically crush them, and we've actually seen very strong resilience, which can be explained by the fact that corporates and consumers were essentially prepared for a higher interest rate environment already. So I think it's really one of these markets where, stocks can differentiate quite aggressively from one another, but the idea is wait until you hear that euphoria around equities. You pointed out we're one of the highs on the street. We're only looking for a 10% return from here. That is not outlandish, but we're still amongst the highest targets on Wall Street, and I think a lot of estimates for next year are still below where we are today. So I would argue that we're still in this sort of wall of worry type of market where everybody's worried about what could go wrong and not focused on what could actually go right.
Let's get to the prospect of broader participation. Can we get profits to pick up even as GDP slows?
Oh, yeah, I think so. And we've actually done the work here. We found that that this has happened before. In fact, in the 1950s, we saw GDP growth slow 3 quarters after profits troughed, and profits rose the entire time. We've already seen margins expanding. I mean, this is quite a shock to all of us, including myself. I did not think we were going to see margins expand this year with all of the cost pressure and wage pressure companies were facing. But I think that we've seen a lot of things happen this year. We've seen companies basically, the companies that overbuilt capacity have aggressively cut costs, cut heads. We haven't seen a broad spread layoff cycle, so the average consumer in the U.S. is still employed and is actually making more money than what they're paying, according to the spread between average hourly earnings and CPI. So we're actually in a pretty good spot when it comes to corporates and consumers. I think the next trigger will be realizing that consumer demand hasn't evaporated. It's not falling off a cliff. Delinquencies are rising, but only back to normal levels rather than, into the stratosphere. So I think those are the aspects that we need to get comfortable around before investors really start taking some risk.
One thing you've not said, rate cuts. And I'm going through the outlook, the research over the last month or so from you and the team, Savita. This line, it's not about rate cuts, it's about what the Fed has accomplished. Can you translate that a little bit more?
Sure, yeah, absolutely. So we're not bullish because we think the Fed's going to aggressively cut rates next year. We're bullish because the Fed has the dry powder, 5 percentage points of latitude to ease our way out of the next downturn. We're bullish because we're past the point of maximum uncertainty. And you and I had talked about this a couple of years ago. It was, in a zero interest rate environment, it's unclear how the world is positioned for that move higher. We're past that point. We've absorbed 2 wars overseas. The market has absorbed a lot of bad news. We're talking about the bad news, and I think that's all bullish in terms of sentiment still being squarely, almost squeamish about really taking risk on stocks.
If I remember correctly, when you upgraded your price target earlier this year, there was a preference there, a more constructive view on the equal weight S&P as opposed to the market weight. Is that still the approach for next year?
Absolutely, even more so because, unfortunately, this year has still been relatively dominated by the, mega cap tech up until very recently. So I think that we could see this sort of broader market trend continue. I think the risks to the Magnificent Seven, they're 7 very different companies, but the risks are not necessarily fundamental, but the idea that they're essentially priced for perfection. Expectations are high for this cohort of the market. So we think that there are better opportunities for positive surprises elsewhere and potentially a higher possibility of disappointing news for the Magnificent Seven. So our thesis is really we're getting comfortable with the idea that you can see rates go from hyper-stimulative to normal and not derail consumers and corporates. We're getting comfortable with the idea that you don't necessarily want to buy bonds at a real yield of 2.5% for the next 10 years. That's actually pretty low. And we think that we're going to see flows and confidence improve as time progresses into next year.
I remember your original price target for this year, before the subsequent upgrades, was 4,000 on the S&P. But credit to you, I also remember a conversation we had maybe 12 months ago where you said the biggest risk for stocks was upside risk. So now we're at 5K on the S&P, Savita. What is the biggest risk around that for you and the team?
You know, I think what worries me is not necessarily what's happening in the public equity market, but what's outside of it. So really the shadow lending and the sort of mini bubbles have been created elsewhere in private equity, private credit. And that seems like a slower, kind of not a car crash, but a slower headwind on risk assets that could play out over the next several years or even decades. I mean, it depends on where interest rates settle, but I think the worry I have is how all of that private funding that we've seen over the last 10 years actually impacts overall consumer health, corporate health, et cetera. I don't think it's as big as the bubbles that we saw created in 2008 or 09, so I don't think it's as systemic, but I think those are the areas where we really need to watch, and we haven't necessarily seen all of that pain play through yet.
Savita, always appreciate the update. Appreciate your time. Savita, thank you. Thank you. Savita Subramaniam there of Bank of America on the year of the landing for 2024. The price target, 5K. Year-end next year on the S&P 500, which, as Savita says, is about 10% upside from here. About 14 minutes into this session as we kick off December, we're lower here by 0.1% on the S&P. On the NASDAQ, we're down by 0.3. Coming up on this program is DeSantis versus Newsom.
This is a slick, slippery politician whose state is failing.
Ron, you're down 41 points in your own home state.
That conversation up next.
When you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center.
And that's news when you want it with Bloomberg News Now. Get it 24/7
on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
I'm a conservative, but I'm not in a bad mood about it.
Fellow governors. Bad mood about being conservative. Is that because you feel like populism has taken control of your party?
And Joe Matthew.
What is it about race that bothers you about the new chairman of the Joint Chiefs?
Our military is becoming so political that we're going to go south when it comes to readiness.
Alongside Kaylee Lyons.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. It's not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg. Context changes everything.
You're trolling folks and trying to find migrants to play political games to try to get some news and attention so you can out-Trump Trump. And by the way, how's that going for you, Ron? You're down 41 points in your own home state.
He's just throwing stuff out to see what sticks against the wall. This is a slick, slippery politician whose state is failing, people are leaving his state, and he's trying to run interference for his failure.
There's one thing in closing that we have in common is neither of us will be the nominee for our party in 2024.
Governors Gavin Newsom, Ron DeSantis holding nothing back, squaring off in a heated debate on Fox News with Sean Hannity. The two clashing over taxes, abortion, border security and energy. DeSantis looking to gain ground on frontrunner Donald Trump ahead of the Iowa caucuses. And Newsom teasing longer-term presidential ambitions. For more, let's get to AMH in Washington, D.C. Anne-Marie, who won that?
Well, I think it depends really how you look at it. I think for both of these men, they feel like they walked away being able to win the minds of already the people that like them, their bases. You know, going into this, there was a lot of thinking that why would Governor DeSantis, who's on stage already for presidential debates, elevate someone like Gavin Newsom, who is not the Democratic nominee and is not going to be the nominee. And that was the line really that stood out for me when Newsom really took a dig at DeSantis, saying neither of us will be our party's nominee for 2024. But DeSantis, after the debate, said, look, I'm in a race where there's a disproportionate amount of media around one individual. Of course, that individual is the former president. So he says if he has a chance to go in front of the American people for 90 minutes and spar and what he calls box someone from the hard left, he's going to do it. It was very substantive, Jonathan, in the sense that a lot of topics were discussed, but all it was a manipulation of a lot of their facts and data to make sure that they can represent their state and their positions well. Already we know how Republicans look at California. They think it's a state of failed liberal policies, and Democrats look at Florida as a place that's rolling back a lot of social policies, especially when it comes to things like women's right to choose and abortion.
AMH with the latest down in Washington. Anne-Marie, appreciate the update. Really do. Let's get you some data, some fresh data, just coming through, some breaking news with Mike McKee. Morning, Mike.
Morning, John. Well, this sets us up for the ISM at the top of the hour. The S&P Global U.S. Manufacturing PMI unchanged, basically, for the last couple of weeks of November, 49.4. The preliminary was 49.4. Last month it was 50, so a little bit of a contraction. We are expecting maybe a little bit of a pop in the ISM, a little bit of an increase because of the auto workers going back to work during the month, but we shall see at 10 o'clock.
And then on to Chairman Powell an hour later.
Then on to Chairman Powell.
Mike McKee, it's one of those frustrating mornings for you. I really know it is. It's like you've got to anticipate something that's going to happen and then spend the rest of the day talking about what happened.
And hope that something does happen. Otherwise, talking about it is going to be difficult.
The Chairman Powell may well stay on script. How to proceed carefully for the 1,000th time from Chairman Powell. Mike, thank you. Let's get you some sector price action. We can do that about 21, 22 minutes into the session. Stocks down by 0.1% on the S&P, on the NASDAQ down by 0.3. With that sector price action, here's Abby.
Yeah, a bit of a snoozy decline here for the S&P 500. John, from a sector standpoint, we do have more sectors down than not, but not a lot of drama here, as you would like to say, or sometimes have said in the past. Communication services down the most, down about 0.7%, but most of these sectors down about 0.3% or less. So the upside is similar story. Industrials is the best, but up by about 0.5%. So not a lot of conviction on the day. But what matters on the day is, even though it might be a tiny decline, it could influence the week, because right now we are heading to another up week for the S&P 500. But fractionally, if it happens, if the S&P 500 doesn't decline by about 0.2% on the day, we're looking at a 5th up week in a row, the longest winning streak on a weekly basis since June. Take a look at the best sectors on the week: real estate and materials as yields go down, and then communication services and utilities. Interesting, utilities being on the downside, two of the worst sectors on the week, John.
Abby, thanks for the update. Coming up next on the program, I'll give you a sneak peek at the rest of today and a sneak peek of next week as well. On the calendar, payrolls Friday. I'll bring you the estimates from our Bloomberg survey up next. From New York, this is Bloomberg.
the younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
25 minutes into the session. Here's a state of play on the session and on the week. On the S&P 500, pulling back just a touch, but still just about on course. And I say just about on course for a fifth week of gains. Positive on the week by about 0.1%. As for the NASDAQ, on course at the moment for the first weekly loss going back to October and down for a third consecutive session. The NASDAQ 100 right now, negative by 0.3%. That's a state of play currently. Let's see if all of this sticks. Let's get to the trading diary. The calendar's shaping up as follows through today and through into next week. ISM manufacturing numbers coming up at the top of the hour. Plus, Chair Jay Powell headlining a busy day of Fed speak, including Goolsbee and Cook. Looking to next week, on Tuesday, we get JOLTS data. Wednesday, U.S. bank CEOs testifying before the Senate. And then the big one on Friday, the payrolls report. And here are the estimates right now in our survey. This can change, but as things stand, 190,000 is the median estimate in our survey. That is up from the previous read of 150. The unemployment rate in our survey at the moment, at least 3.9%. The previous read, 3.9. More on that through next week from New York City. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day and enjoy your weekends at home. This was the countdown to the open. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com webinars.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep Great World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up, Bloomberg Markets. We have Molly Smith sitting in for Matt Miller for the next few hours, so that's good fun. We're going to start off. We're going to talk to Joe Matthew. He's the host of Bloomberg Sound On and Balance of Power. Discuss what's happening in D.C. George Santos, is he in or is he out? We're going to talk about the Biden administration as well in terms of the Israeli-Hamas war. Tech Talk, Charlie Hernandez, CEO of My Pocket Lawyer, joins to discuss how AI can be used for a profit tool to expand access to legal services and serve as a benefit to the legal industry. And then we're also going to check in with Megan Horniman. She's the Chief Investment Officer at Verdant Capital Advisors to get her market call. So a lot happening here in this first hour, and we're going to kick it off with Bloomberg's John Tucker.
All right, Paul, and I think it's pretty safe to say that we're in a holding pattern ahead of Chairman Powell's talk today in Atlanta. Right now, the S&P 500 unchanged, 45.67 on the day. The Dow Jones Industrial Average, 58 points higher. That's up 0.2%. The Nasdaq 100 right now, 51 points lower. That is down 0.3%. And after, I'll use this line again, the November to remember for stocks and bonds, 2-year yield right now, 4 basis points lower at 4.63. The 10-year, 3 basis points lower at 4.28. But you know what? Gennady Goldberg at TD Securities says investors may have gotten ahead of themselves by pricing in rate cuts by the Federal Reserve. Well, he did say that. Guarantee me. Again, the S&P 500, 3 points higher, up 0.1% at 45.71. And looking at the VIX right now, it is 1274 right now. So at historically low levels as we get set up for the Fed chairman a little later this morning. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Molly and Paul.
All right, John Tucker, thank you so much. John, we just had the ISM manufacturing cross, 46.7. Expectation was for 47.8, so it came in weaker than expected, in line with last month, but still contracting on the manufacturing side.
Just to remember, it is what, 50 is
Yep.
the dividing line between expansion and contraction. And when it comes to manufacturing, that's the smaller part of the U.S. economy as compared to, say, services.
I'll hop in here. I wrote the story, so it seems fitting.
I forgot. We have the
So talk your
Bloomberg
own book now.
Yes,
Sorry.
Exactly. We have Molly Smith, folks, by the way, is our co-host, but her day job is she covers the economy for Bloomberg News.
Yes, this is my part-time job on radio. So what I do for the rest of my day is write about the economy. And so this the ISM report today. So yeah, we've seen manufacturing's been in contraction for more than a year now. And what to me really stood out was the new orders gauge. This is like gauging really where demand is at. This is now contracted for 15 months, longest streak since the early 1980s. You guys remember that time?
Sure.
When the Fed last hiked rates at this kind of pace. So that to me was very telling.
But it's better than last month, 45.5. Do we take any solace in that?
No, it held at the same.
Oh, it held.
Yeah,
Okay.
but I think so. That is a good point there, Paul, to note that it is stabilizing at a weak level. I think that's the takeaway from what we're when we talk to economists, that it's not getting any worse.
Okay. All right, good little read there from our in-house economy reporter who also doubles as a co-host for radio. Take a look at these markets. A little bit of red, a little bit of green on screen. Let's check in with Carmen Reineke. She covers all the markets for Bloomberg News. She joins us here in our New York studio. Carmen, what are you looking at under the hood here in this Friday?
Yeah, so the first stock that I'm looking at this morning, Ulta Beauty, ticker ULTA. It's up about 12% after it reported a sales beat in the third quarter and raised the lower end of its full-year earnings per share forecast. Analysts are saying that the company is really navigating through a challenging consumer environment well, showing that consumers are still willing to, pay for their beauty and like self-care supplies. On the flip side, some analysts have also said that Ulta set the bar very high for 2024. So there might be some hesitancy there, going forward if the consumer will continue to buy.
What isn't that? Okay, I know I'm going to trip up on this line again because, Paul, you had to help me last time. Under promise, over deliver. Why aren't they doing that?
That's a really good question. I mean, I think, after a good quarter, and this is just, they're raising the lower end of the full year guidance. So they're just narrowing, where they think they're going to be. Maybe if they were raising the upper end, it might be even more of a.
Wasn't that, what's that, like the term, like a lipstick? It's something in recession, right? That you still buy those things, make you feel nice.
Well, this is why I think, I remember during the beginning, in the depths of the pandemic, that Sephora store across the street, packed.
I mean, yeah.
People get their makeup. I don't care what's going on out there in the world.
Yeah, exactly. It's something that you use every single day for a lot of people, and yeah, you're not going to cut back on that cost immediately.
And like just in our little square block here, Lexington Avenue between 58th and 59th, all the stores in the ground floor retail went out of business.
Decimated.
With the exception of Sephora. And the little Dutch chocolate store downstairs.
You know what my old boss used to love to say? We would notice on a rainy day that Sephora would get flooded for people taking cover. And be like, great, they're buying lipstick, good for GDP.
Yes, exactly. How about Dell Computers, or Dell, I guess? What's the story there? Because I see that stock down.
Dell Technologies, it's down about 6.5% right now. So it reported quarterly revenue that fell short of expectations, again, because of a miss in PC sales. And this is a story I think that we've seen before with Dell. These personal computers are just, the demand is just not there. They also forecast that they're going to see demand even lower. Their fourth quarter revenue guidance, they say, will be about $22 billion. Analysts had expected nearly $24 billion. So further weakness there, potentially ahead for Dell Technologies.
And how about Marvel? That's another one that you had flagged to us.
Yeah, so this is an interesting one because it's, it's the chip maker, right? But shares are down right now. They're down also about 6.5% for ticker MRVL. The chip maker's fourth quarter revenue forecast also fell short of expectations, and third quarter missed estimates. The interesting thing here is that they also have a data center and like AI segment that did pretty well in the quarter, but it wasn't enough to offset the weaker parts of the business. So that's interesting. I mean, it shows that maybe that's not going to be like the Band-Aid fix-all. It's also worth noting that shares of Marvel were up more than 40% so far this year. So this also just could be investors like looking to lock in some of those gains. That's like a really nice run up.
And of course, another big mover today, Pfizer. I guess they're one of their weight loss drugs not working so well.
Yeah, one of the big stories of this year obviously has been the GLP-1s, and Pfizer is sort of late to the game here. And so what happened this morning, they're down 7% after saying that they're dropping the development of a weight loss pill that would have been taken twice a day due to side effects. So that's a blow to the efforts for new avenues for growth. Pfizer has been under pressure after their COVID-19 vaccines and treatments just like aren't getting, they don't have the same demand that they used to. The one good thing here is that Pfizer is still developing a once daily pill for weight loss. So that is still in the pipeline. And they've also invested really heavily in acquisitions for cancer drugs and cancer research. So
yeah, stock down big this year to date. They've had that hangover from all the COVID revenue they had, which almost doubled the size of their revenue over the pre-pandemic to now, and now we're seeing the revenue guidance come down dramatically, like by billions of dollars. They're cutting revenue.
I mean, if you are going to be looking for the next big market, I would think obesity is a good place to tap into in this country.
Yeah, absolutely, absolutely. And again, Bloomberg Intelligence has put out some definitive research on this whole GLP-1 marketplace. They sized up the market on a U.S. and on a global basis, listed who the competitors are and who's really got a good shot at doing this, and they forecasted it out many years. So you can go to BIGO and just type in the search bar, the GLP-1 or obesity drugs, and that'll bring you to this report. It is the definitive report out there on Wall Street. Carmen Reinecke, thank you so much for joining us. Carmen Reinecke, give us an update on these markets. A little bit of red, a little bit of green after what was an extraordinary November, up about 12% for the S&P 500. We saw 10-year Treasury yields, during the month fall from, just around 5% to the 10-year today's at 4.29%. So some big, big moves out there. And a lot is happening down in Washington, D.C. The folks down there tend not to sleep. It's kind of like, the city that never sleeps. But we took that. Here in New York. And Joe Matthew, he is here in New York speaking. He is this radio and TV host, Bloomberg Sound On and Bloomberg's Balance of Power. He is our go-to person in D.C.
We roll up the sidewalks at like 10 o'clock, actually. It's a ghost town. I have to it is not New York.
Okay.
Yeah.
Unfortunately, I think we have to lead with George Santos. It's a little embarrassing.
No, why unfortunately? This is the best story.
Exactly. What's going on down there with him?
Well, he's about to get fired, it looks like, and we don't know this for sure. The Speaker of the House, Mike Johnson, says he's actually going to vote against expulsion. The Majority Leader, Steve Scalise, says he's going to vote against expulsion.
Why?
Because he hasn't been convicted of anything, and I have to just look. They have a 4-vote majority, 4 seats.
My goodness.
Losing one right now would be extremely difficult for the party, but they're afraid to set a precedent because, look, if you ask George Santos, and you might not believe what he tells you, he'd say, this place is teeming with crooks. You expel me, I'm taking others down with me. And I think it's actually making people think about the precedent that might be set if they're accused of something and they could get fired, which is apparently going to happen. Every Democrat looks like will vote to expel. They only need 90 Republicans to do it. It's highly expected that he will be fired today.
Really? First of all, I didn't know you could do that. I thought only your constituents could vote you out.
Yeah, how about it? It's only happened, 5 times, and it's been 21 years since this took place. Remember James Traficant, Beam Me Up Scotty, known for his hair and his denim suits. This is the first time in a long time, certainly.
What do his constituents have to say, if anything?
Oh boy, they got to be embarrassed.
Yeah,
I mean besides, being mortified.
There's a reason why it's expected that this will flip to a Democratic seat. The New York delegation is mortified. We had Nicole Malliotakis on the other day, a fellow Republican. She said simply, he's got to go.
Interesting. All right, more serious business. Just give us a sense kind of where we are with this Congress. In terms of getting stuff done, I think keeping the
this is the comedy portion.
This is serious business.
I mean, where are we on that? Because there's so many things that hang in the balance.
Well, that's for sure. Look, we don't really know. The government's set to shut down in 49 days if nothing gets done. By the way, they have something like 19 legislative days in that period of time to get it done. And it looks like we've got a couple things. One, they have to fund the government. There is no clear path to make that happen. And if there's another continuing resolution, it could get the speaker fired. We just went through this. In the meantime, we have funding for Israel and Ukraine.
Yes.
Tens of billions of dollars. And without a deal on the border, it looks like that will not pass. Wow. So there's a concerted effort right now to get some sort of grand bargain on immigration reform, specifically border security, could lead to a change in asylum law. And there are now Democrats running for re-election who are suddenly open to this idea. So it's entirely possible this could happen. Whether it's done by the end of the year is another matter. And if you're in Ukraine right now waiting for money and waiting for support, you're probably not holding your breath because it's going to take a minute.
Right, I would think not. And then Joe, if you can help us out here, because when we're thinking about this Congress and how the latest shutdown did require some bipartisan support, right?
Yeah,
that
right.
To keep Mike Johnson to get this deal going. How likely then are the hardliners going to be? Are they going to be sympathetic in case they need another bipartisan